All right, so let's get this started here in just a few minutes. I think we are live right now. We're going to give it a couple of minutes, see if anybody's kind of out there. All right, if you can hear me, fantastic. Should be good to go. Let me know the mic is good. Today we're going to look to cover a couple things. This is the first time I'm streaming on this channel, so welcome. A lot of things that I do, I focus more for the advanced user, intermediate to advanced, when we deal with option trading, swing trading, but a lot of focus on options. So I thought we'd go back to basics. Sometimes getting too far, too advanced, too quickly leaves out the little guys. So we're going to try to go back to the basics and kind of start fresh. And in this segment, what we're going to do is we're going to go ahead and just cover things as far as investing goes, investing for beginners, just kind of getting started, getting things, getting your feet wet, and how that's all going to go, play out, give you some basics, give you some foundations, things to think about, investing in stocks in the long term, looking at things like brokerage panels and platforms, charts, risk profile pictures. So we're going to do quite a few things today, and it might take a little bit of time, but Fridays are a little bit lighter days for me. And hey, how you doing? Deep sun. So we're going to give it a 1 or 2 more minutes. I'm going to go ahead and take one drink break, just make sure everything else is set up, and then we're going to get started. So I'm going to see you guys in just a second. Just double check all my batteries here, and we'll be back to kind of start with the schedule here real soon. Okay, so give me just a moment. I'm going to check everything, and then we'll get started. It's really for beginner. Yeah, we're gonna really go into beginners and for basics. So if you're a little more intermediate and advanced, it's probably not one that you're gonna want to stick around for. If you're kind of getting started, beginner, then we're gonna get deep into it here very soon. So give me just 1 second, and then we're gonna get into it. Okay. All right. Hey, Steven, how you doing? I'm going to try to have a good session tonight. We're going to try to work through a lot of material. Some of this, for some of you, will be very basic. For others of you, it's going to be very intense. So just prepare. We're going to try to get going. I'm going to try a couple of new things here as well. Very good. Thanks. Awesome. I'm really tired, but still doing well. If you're not sick, it's always a good thing. Hey, yeah, absolutely. Hey, I find that a lot of people just leave off the beginners, the basics. So we're going to work from the ground up. If you think some of the things are going to be basic or a little too basic for you at the beginning, hey, go grab yourself a drink, go enjoy a show, another show, read a book for a little bit and come back, because we're going to cover a lot of topics. So our schedule, hopefully I spelled it right, our schedule for today, we're going to do a quick little introduction, what we're going to cover, which is what we're doing right now. We're going to go into how a stock works. How do you make money from a stock? How do these investments work? We're going to go through that fairly quickly because I do have some good YouTube videos on this as well. We're going to look at risk profile pictures of a stock. How does that all play in? How do you evaluate the risk of a stock? We're going to look at compounding. We're going to look at reading charts. Portfolio allocations. We're going to take a look at a keep it simple approach to kind of investing, doing it through ETFs. Target date retirement funds. We're going to look at selecting a broker and some fees and kind of compare it a little bit to money managers or wealth managers as well. Putting on a trade. We're going to look at some basics behind that. Managing the investment, a real simple approach, right? Nothing too crazy right now, because otherwise it would just, each one of these topics we could spend days on. But this is just to kind of give you a good foundation. So managing the investment and then protecting the investment with kind of options and protecting your portfolio as well. So we'll see how far we get. Hopefully we'll get through everything. I think it's going to be at least 1 or 2 hours. So we're going to go into it for a couple hours here, and however long it takes, that's how long we're going to stay for. So I don't think it'll be as detailed or depth as some of the courses that I have. So for those of you that have seen some of the things that I do, we have a lot of courses available on our website, Rise to Learn. So there's quite a handful of trading courses that I've made over the years. A lot of them also, the people that are interested in the courses are really in the options segment. That's way more advanced than what we're going to cover here. So if you're interested later on in trading a little bit more actively, this might be an approach to go with. But as far as what we're going to cover here, this is going to be kind of the basic, simple, keep it simple approach, couch potato strategies, that kind of stuff. So that's really what we're going to kind of cover today, is just the bare bone basics. There's a lot of other freebies for trading if you want to get into trading, like getting started guide here, trading stocks online. If you want to check that out, that's all free, very useful. And for those of you looking into options here as well, the same thing, options trading 101. And we're not going to get this depth into it. We're going to go into kind of the basics right now. So I think it's important for everybody to kind of understand what's the point, what's the purpose of really looking at these investments. So we're getting into the introduction here. What's really the point and purpose of getting into stock investing? And there's a lot of things out there when it comes to stock, when it comes to investing in general. I mean, you could put your money into real estate, you could put your money into stocks, you could invest into businesses. Ultimately, as they say, you probably know, diversification is key. So if you are diversified, you might go ahead and make a little bit of money from businesses, you might make a little bit of money from investing in real estate, you might make some money in the stock market. Now, in a way, you could say, hey, pick your poison or pick your golden egg. Some people focus on one specific thing. Other people like to spread their money around. It's really up to you. For me, I've invested things in my business here, and I have multiple businesses, similar to how, we do things on YouTube, we do things with books, but I also have some other subset businesses beyond that I don't really make too public at the moment. But then also I do investing in the stock market. Other people that I know really hone in and focus on real estate. So which one makes more money is really, I think it depends on what makes more sense for you. It's kind of like, if you're a person that's a stay-at-home mom, and you have 5 kids to work on and you're homeschooling them, is it really wise to go ahead and be a day trader or try and trade stocks like every single moment of the day? It's probably not going to work. In the same context of if you're trying to invest in real estate and you want to put the sweat labor or sweat equity in it, because that's how you make a lot of money from real estate. You do it by, hey, I'm going to go ahead and change out this sink. I'm going to go ahead and remodel the kitchen. Well, if you're kind of paralyzed like one of my buddies, does it make sense to go into real estate? Probably not. So maybe stock investing would be the better approach for somebody like that. So your situation is different. And I think before you even get into the context of, hey, I'm going to invest in the stock market, understand where your position is. What makes sense for you in your personal lifestyle? And I think that's where people go wrong, because it needs to match up with what you're doing and your personal life. It's kind of like, hey, I want to go ahead and drive a Ferrari. Great, but you have 4 kids at home that the only time you do driving is when you're with the kids. So does it make sense to have a Ferrari? No, it doesn't. You're better off getting a van. And some people say, hey, well, I don't like a van. It doesn't look good. Well, you might think, hey, an SUV is better, but you still got to carry the kids' stuff. So anyways, it's a personal taste. What makes sense along with your personal taste, and then all of a sudden blend it and see what works for you. So all of that we're going to be focusing on really here is going to be stocks. That's my main goal. That's my focus for today. And I want to share with you kind of the basics behind it, and really just for you to understand how to make money with it, the right approach, especially if you don't want to put too much time into it right this moment, or if you don't want to have a money manager, or if you want to just do it on your own. Because the person, as I always say, that's going to care the most about your money is going to be you. Okay, not a money manager, because they typically, what they focus on, the first thing is them, then their job, and then maybe you, and then your money. So that's typically the hierarchy that it goes, and that's just human nature, human behavior. So in either case, let's get started. We're going to go in and go with, how a stock works. We're going to go through this quick because I have a video about this already. So we're going to kind of get into this real quick right now. We're going to do a few things on paper, and then we're going to go ahead and do things also on screen. So I have a couple of panels and platforms here to show you guys as well. So, all right, so let's get started. We're going to first go on paper here. And as we go into looking at how stock investing works, so let's just take a look. Okay, so how stock works and how you really make money. So ultimately, a lot of people, they get boggled down into, what's the purpose, what's the point of a company going public and all of that. You don't really need to know that. It's kind of like, hey, if I go to the gym and I want to go ahead and lift weights, do I really need to worry about what the other guy is doing? No, not really. I need to worry about, hey, is he on my weights? Is he taking up space? Is he in my way? That's what I'm focused on. So you don't really have to know the whole process of why companies go out and become public, but ultimately they do it in a way to get more money. So the way that they do this is they go public, they get more money by selling a little piece of their company. Now for you, what you do is, okay, so let's say this is you want to go ahead and take a little bit of that money that you have. So you've got this little bit of a bank account right here, and you want to take that money and you want to invest in this company. So whatever the company is, okay, you want to go ahead and invest that money into this company, because eventually what you hope to do is that later on, with growth, as this company grows with time, you cash out. And this is basically a way that appreciation works. It's kind of like in the same concept of, let's say you go ahead and you buy a rare coin. Okay, so you buy a rare coin, you hold it for 10 years, and then after 10 years, this rare coin went from you buying it for $10, and now maybe it's $25. So not a huge appreciation, but now you can go ahead and sell it. Maybe certain coins are, as I know a friend who's big into coin collecting, some of them are millions of dollars, but let's say a coin is like $4,500. And now, later on, multiple years later, that coin might be $9,000, the value of it, just because it's become more rare. So you're looking for this appreciation effect to happen with a company and with a stock. So really, everybody that wants to get in it, you just take a tiny little slice, and I probably can't even draw the minuscule amount of that slice, because what happens is this is divided. It could be into 10 million shares. It could be into hundreds of million shares, and you're just taking a fraction. You might take 100 shares. You're taking a little piece of that company. You might take 500 shares or 1,000 shares, and every stock has its own price. It has its own price value, and as it fluctuates, it might start heading down and up, and this price is constantly moving. Sometimes that stock is $10 a share, other times it's $25 a share, other times it's $250 a share. So if we go ahead and take a look at kind of an example of stock chart right here, some of you guys probably heard of this company before. It's called Apple. Apple right here is basically, right now $282 per share. You can kind of see the price right there, and it's wiggling. It's moving around. Now we'll talk a little bit about charts here later on as we get more into section 5. But ultimately, the price wiggles around, and say, for example, somebody bought that stock sometime over here in December of this last year, and then they went ahead and sold it right now. Well, how much did you make or lose? Well, here's kind of the movement. It's a little slow of a steep movement, so I can't really draw that angle. But let's just say you sold it somewhere down here. Well, have you made or lost money? Well, if you bought something at basically $280 and got out of it at $220, well, you've lost $60 for every single share that you had. So if you bought one share, which cost you $220, then you lost $60 if you sold it at, you bought it at $280, you sold it at $220, you lost $60. And that's on a single share, but you could have 2 shares, 4 shares, 10 shares, a million shares, however many shares that you kind of can afford. So in either case, as far as making money, if you sold it near the top over here, well, you went from here, the same thing, let's say 260, you bought it around 260 and you sold it at 320, so that's $60 the other way. And you made $60 for every share, right? You bought a cell phone on eBay for maybe 40 bucks, you fixed it up, and you sold it for 100. How much did you make? You make 60. So that's the same way that stock investing really kind of works, is that you buy something at a lower price, sell it at a higher price. Now, there's other ways to trade stocks. You can also sell it first and buy it back later. This is known as short selling. We might cover that a little bit later if you guys are interested in that. But ultimately, when it comes to a stock, there's just a couple of quick things you got to really know. Okay, so first off, when we look at stock investing, okay, and you want to go ahead and, let's say, buy shares, every company that's listed on there is traded by the ticker. So this ticker symbol, you might have like MCD for McDonald's, MSFT for Microsoft, I think it's PINS for Pinterest. You got NVDA for NVIDIA, AMD, you just saw Apple, and many more. And you'll get more familiar with these kinds of things. Ultimately, as we get into a lot of the keep it simple approach, you're not going to really need to know all of these, but unless you want to pick specific stocks, that's kind of a really tough game to get into. But in general, everything has a ticker symbol, and that means including companies. There's also things to trade like ETFs, which are baskets of stocks. This might be like SPY, IWM, Diamonds, DIA, EEM. So you have these kinds of things. And you have indexes, which indexes cannot be traded by buying the shares, but they can trade options. And this would be kind of like your Dow Jones, or the SPX, which is the S&P 500. Now, the SPX is 10 times the size, just in case you guys were curious, of the SPY. So there are ETFs related to indexes, and the Dow Jones is related to the diamonds. So if you look those things up, they're very similar in price. They wiggle around. It's just they are 1/10 the size. And also, just in case you were wondering, you've got the Russell, RUT, and you've got IWM that you can go ahead and buy. You cannot buy the index. You can trade options on them, but you can't buy them. But ETFs you can invest in. And a lot of times, this is what we'll talk about later on, is that you might want to just invest in an index or some kind of fund, rather than individual stock picking, because this is already a basket of, let's say, 500 stocks. This is a basket of 2,000 stocks. So it just might be a better and smarter approach for most people. Okay, so that's kind of the initial basic part of what you have to know for the ticker symbol and kind of what's traded out there. Now, a lot of times when you're looking at price, because this is what people look at to get into a stock, you're looking at price. And when we look at price, a stock might be trading at $86.47, and then you might see something like this, $87.25. So you have kind of the bid and the ask spread. So here you might have the bid, this is the ask. Think of this as the auction. So if you want to go ahead and buy kind of a cool camera, okay, so you've got this cool camera that you want to buy, just it might be on eBay or wherever. You know, somebody's asking maybe a $87.25, but right now the current bid is only $86.47. Now you, if you want to get into the stock and you want to buy it, could you bid a little more? Yeah, you could try to bid more, and you could bid or buy it now at their asking price, or you could try to kind of go somewhere in between as well. That's fine too, and that's kind of possible if it works out. Now with stocks, it's no different, except this bid-ask thing is changing every second. So as we see price wiggle, you know, the next second you might see 89, you know, depending on, you know, a minute or two later, 89.22 to 89.75. And this bid-ask spread varies from stock to stock. Some stocks have a very wide bid-ask spread, and other stocks have a very tight bid-ask spread. So if we go ahead and take a look at kind of, let's say Apple here, and you can see here the recent, this is, by the way, a trading program. This is a broker. This is called Thinkorswim by TD Ameritrade. Here we have our bid, and here we have our ask. So you can see people are trying to bid or buy it at $281.83, but the asking price is 7 cents higher than that, $281.90. Okay. So if you go into something like a CMG, which is Chipotle Mexican Grill, you have a way wider bid-ask spread. Okay, so here you have 886.17 and 891 is the ask. So basically almost a $4 spread difference. So you can see I went ahead and typed something up real quick, and you might think, hey, he's going a little quick. CMG is the ticker symbol. This is the ticker symbol that we talked about for Chipotle. And just to mention a few of those other ones that we talked about, we said McDonald's, MCD, there's McDonald's Corporation. You could go ahead and look at Pins, there's Pinterest, here's Microsoft, and so on. You can see the different bid-ask spread. Now, what you're really going to do is look at things in a quote window. And this is really what the basics is. This is called level 1 quotes. There's also level 2, not that you really need to worry about it. If anybody's trying to sell you a course on level 2 or saying you can get a huge advantage, I wouldn't really bother on it. Level 1 quote is the basics. You're going to look at it. This is all the information that it kind of contains. So you could pick any stock right here, and what you have is basically the last price. So that is the last traded price, and this changes every second, right? Every quarter second sometimes. You have the net change from the previous day, right? Because stocks close and open with the previous trading day. Then you have the bid, the ask, and wouldn't worry too much about size. Volume is the amount of shares traded, not the number of people, but the number of shares traded in that given day. And this is what it opened at, the stock price opened at, and for the day opened at, the high of it and the low. And this is ultimately, when you look at this, it's going to represent these charts. So when you look at any bar here, you might see, hey, this is kind of the open at this price, the close, and it went even higher. There's the low and the high, and you have other little bars here as well. So again, it might have opened, closed, wiggled around at the highs here, wiggled around at the lows, and that's kind of what these bars represent, just as a rough idea for you. Okay, so as we understand now just kind of the basics behind stocks, I think a lot of people probably understand these kinds of basics. Are there any major questions behind this? Just on the way that it really works. The simple point behind it is you go ahead and you need if you're interested in investing money, okay, so let's say you want to invest money. Let's just do a big summary. You take your money, you go ahead, you give it to your broker. This is how you do it. You put it into a broker. This is kind of like a bank. Okay, from this bank, you go ahead and you use it to buy stock, of a certain company or index that you think is going to appreciate in value, over time, what happens with that stock? Does it appreciate or does it depreciate? You either make or lose money. So here you could go ahead and buy 10 shares, 500 shares, however many you want to have. So it's like buying 10 cameras, 500 cameras, 1,000 cameras to later resell. So you buy the stock using your broker, and then later on, with time, you go ahead and you do the same thing in reverse. You go ahead and you sell the stock, meaning you close the deal. So in a way, this is kind of like, hey, I've bought my phone, my phones or my cameras, and now I've sold my cameras and I've shipped the cameras. So now you're selling to close the transaction and finish it out. And that's it. And then the process really loops back to the beginning. So, or pretty much in the beginning. You go back to deciding on, hey, which money do I want to invest, or what money do I want to take and invest? And since you already have a broker, you bypass this step, and then you bypass, this step. You just go from here, buying the stock, you loop it back, you buy the stock, you sell the stock, you buy the stock, you sell the stock. So you have this cycle that just keeps moving on and on. For some people, what they do is they kind of go on this tangent where they buy the stock and they hold it forever. Is it a good thing? Is it a bad thing? That's a personal take. If you're getting dividends, that's kind of a good thing, I guess. But you never know if the stock will ever be delisted, or if the stock will kind of just continue to lose value, or if it's not diversified enough. So that could be a little bit of a bad thing to some level. So again, just a personal investment take. Now, one thing I did just mention that you need to understand is not only do you make money from appreciation. So let's talk about this a little bit more in detail. So the first thing that most people understand is the appreciation factor. So you make money this way, okay, because you buy it low, stock goes up, you sell it, and you make money. But you also make money from dividends. And what does that really mean? So a lot of people don't understand dividends, and dividends are typically, not always, but typically paid out 4 times a year, okay, with many companies, but not all companies. So not all companies pay dividends. And what you do when you're looking at dividends is dividends, they're basically a payout for a loan. And in a way, what you're doing, as we talked about at the beginning, is you're loaning money to this company so that they can use it for marketing, for investments, for a lot of different things. So what's happening is that this loan money is now giving you dividends of repayment. Okay, so you've given them a loan, and every quarter they give you a certain percentage. So they go ahead and give you a percent of that money. Now, some companies give you a higher percent. So you might get a higher percent, and other companies you might get a lower percent. Now, why might one company give you a lower percent? Well, because they think it's a great company, because they know that they're going to get more appreciation. So for example, like Apple did not give a dividend for a long time. And even now, the dividend is not an amazing dividend. And when you look at higher percent like AT&T, they might give you a high percentage, but the stock does not appreciate very well. So the chart is kind of flat. So there's always a trade-off, right? There's no give-me's in the world. A lot of times when you go in and you want, let's say, a high dividend paying stock, well, you might not get the good appreciation. And other times when you have good appreciation, you might not even have dividends. So just as a quick note here, how do you go ahead and look up some of these dividends and things like that? Well, you could just go ahead and you could pop it into your favorite browser here. So let's just say I go into Google here and I type in, let's see, McDonald's dividend, right? And if I'm going into McDonald's dividend, you can see right here, dividend yield 2.49%. So that's basically telling you, hey, you're going to make 2.49% return on your investment. Now, it also talks about dividend growth. So how much has the dividend grown over the past, 3 years or so? What is the annual dividend? It's basically $5 per share, or the percentage here is 2.75. Recent quarterly dividend payment was made on record on March 16th. So there's a lot of things that you have to hit and make sure that it works in order to get the dividend. You can't just buy the stock before the day before they release the dividend, because it takes like 3 to 5 days for it to clear, because you've got to be in the books. And then once you're on the books, then yes, you could just, some people do play that game where they get in the stock like 5 days before the record date, and then they get the dividend and they get out of the stock, and they constantly rotate from different stocks. But it's a tough game to play and calculate. So because sometimes stocks sell off in between that time frame, because they know that it's going to happen. So anyways, what you can also do is go into websites like dividend.com. There's a ton of websites out there. So you can see dividend yield, dividend annualized payout ratio, dividend growth, how long's the growth been. And this is normally what you want to look at, is when you're looking at, hey, how has the growth been? And normally people who are just long-term investors, just buy and hold investors, they typically make the most according to research and studies. And if you just back test some stocks and investments, they make the most by holding dividend stocks. If you're trying to find like stocks that are, penny stocks or $10 stocks that are, going to explode to the moon, it's not the right business. This is not the way that it's going to build wealth in your life. And it's a slow process. I hate to break it to you. It's a tough business. You can't just, stock picking is very tough, especially if you're not that involved in it, right? If you're getting more deeper involved in it, learning and understanding charts, trends, really managing your money actively, that's a different story. But as far as the basics go, it's not the approach you want to take. So if we go in and let's just say SPY dividend, which is the SPX, right? So this is kind of the diversified version of it. You can go ahead and look at stock websites like NASDAQ right here, which also is very cool that I like. So it tells you right here when the payouts are, and the cash amount is 1.406 per share. And you can see here it was 1.57, sometimes a little less, sometimes it's a little more. But you can see normally what you try to do is from 2013 all the way up, you're trying to get that to grow. Because even if you had the same amount of shares, you're basically looking for that stock to grow with time. So this is ultimately what you're looking for when you're looking for long-term investing, when you're looking for buy and hold situations, buy and hold scenarios. You'd love for a stock to grow its dividend with time. Not every stock does that. Let's take a look at maybe another one, AT&T. Any of you guys want to look at any specific stocks, by the way? AT&T stock dividend, just let me know and we can check it out. So here's the NASDAQ dividend history, and you can see right there. Okay, so here we've got 0.45, 2013, you can see 0.49. But when you look at the percent, right, it may not seem like a lot, but the dividend yield is 7.06. Now, why is this dividend yield way higher than the SPY that I just talked about? Well, it's because of the price per share. You're making 7% on your money versus the other amount, which is a lot less. Even though the cash payout's 52 cents, the percent yield on it is way more. Because if I compare, let's say, AT&T, it's only about $29.71 per share. So you could get a whole lot more shares with your money. Whereas if you look at SPY, it costs you $282.97. So you can't get the same or as much with your money. So that's why they use the dividend yield percentage. Okay? Привет. Yeah, so hey, how are you guys doing? All right, so I think that's a good kind of intro to just basics of stocks. And what I want to do is next go into looking at a risk profile picture. I don't think a lot of people really know how to look at this or use this. So we're going to take a look at a risk profile picture for stocks and just show you what it really means. So if I was to go ahead and look at buying a stock. So let's say I already know Q&As. If a company, okay, let's go ahead and do 1 or 2 Q&As. We don't have a ton of people right now. Maybe it's what's it called? Friday night, so who knows? Okay, let's see here. See if I can do this. Okay, Deepson says, if a company is going good, then will the company give dividend, even not sell our share, just doing hold? If a company is going good, then will the company give dividend? I'm not sure what you mean exactly by that question. I think what you're asking is that if a company is going good, and if let's say it's appreciating, if it's appreciating well, then yeah, you could hold on to the shares, and it may not even give you a dividend. Other companies, yeah, they typically don't change the dividends around too much because they know that people stock investing because of the dividend. And if you get rid of the dividend, it really affects them in a big way. So most companies don't really cut dividends. Sometimes they do, but they usually grow the dividend. So I hope that kind of makes a little bit of sense. Okay. Any other questions? If not, we'll continue moving forward. We're going to go ahead and look at risk profile picture of a stock. And I think this is one of the things that most people, when it comes to the basics, don't really understand. Okay, okay, righty. Let's see. Let's just go back here. All right, righty. Righty asks, what does he ask? He asks, what is the best strategy for someone who has a day job? Okay, if you've got a day job and you're looking to invest, normally for most people with a day job, unless you're trading with alerts, it's a little bit tough, right? It depends. Do you want to just look at basic investing? You want to be an active investor? Or do you want to trade kind of options? So you kind of have kind of that sweet spot. It's kind of like passive income. A lot of people look at, hey, I want to make passive income. But what does passive income really mean? There's really no such thing as passive income. If you go ahead and write a book, which I've written a handful of books, and you want to go ahead and make royalties from it, the initial amount of work that you have to put in is a lot. And then you just get royalties and so on and so forth. Then you get into kind of, let's say, passive income on membership websites or courses. But even then, even that's not so passive. People either want refunds, people forget their password, they need help with that, they don't understand the concept. So you still have to go ahead and promote courses and interact with people. So passive income has its different levels and stages. And the same thing here is the best strategy. I wouldn't say there's a best strategy of anything. I'd say there's different strategies and there's pros and cons. So when we're looking at, let's say, somebody with a day job, I would say somebody with a day job should not be day trading. Instead, what they should be doing is maybe swing trading or swing investing or long-term investing, kind of like what we're talking about now, putting it into dividend stocks or ETFs. That, I would say, is a better approach. If you can't look at the markets in as much detail, then I would say, don't even bother doing any shorter term duration trades that are like seven days or less. So that's what I would say, is that look for more longer term investing, something that's, further out in time, and just let the money grow for you. Because what you're having is now you have a stable source of income, and you take that stable source of income and you just put more money in stocks every 3 months, kind of repeatedly. It could be every 6 months, it could be once a year, or whatever frequency you want to do, and that just averages you out for the next leg up, because we typically have inflation and the market in general goes up. So if we take a look at, let's say, SPY right here, you can see that in 1989, right here, the market, this SPY, was way down here, like 20 bucks. Just because the value of money, the value of gas prices was a lot. They talk about the hamburger model of how many hamburgers, because pickles, tomatoes, lettuce, bread is the same. How many hamburgers does it cost to buy a house, an average house? Well, back here it was a lot less hamburgers. Now it's a lot more hamburgers. So anyways, things just continue to inflate, right? Things used to be a lot cheaper back in the day. Now they're just more inflated, which means the value of money becomes worth less and less over time. So anyways, I hope that makes sense. All right, wonderful. It does make sense. Okay, so let's look at the next segment here, and this is a risk profile picture of a stock. I think anybody that wants to get into some basic understanding of a risk, which is the business you're in, is risk management, you got to understand this risk profile pictures. You have to. And a lot of brokerage platforms don't even have it, which I don't really understand. You know, you got a lot of people that are interested in like Robinhood apps and all these other things, but they don't have like risk profile pictures. And people here are trying to trade $20,000, $50,000, and they're worried about the $5 that they'll save on commissions. I mean, come on. Anyway, so let's look at risk profile pictures. And what a risk profile picture does is right here. Let me draw one out for you. Actually, I have a printout of a risk profile picture. We just used it in a course not too long ago. So this is a risk profile example. Now, each one of these, A, B, C, and D, is a risk profile picture. Actually, I'll go ahead and do a big one first for you guys because I have one handy right here. So here's a risk profile picture. And what this risk profile picture does is it tells you your risk on the trade. Now, for some trades, you're going to have more or less risk. And what happens is at the bottom, you have this axis. This is the price of the stock or the price of the ETF or the underlying, as a fancy word would say. And here's your profit, and here's your zero line. So if you go ahead and buy a stock at $170 a share, well, that means you're breaking even, right? You bought it at 170. The value of it at this exact moment in time has not changed, right? If you bought it at 170 and you can sell it at 170, of course, there's always slippage costs because it costs you to buy the shares, and maybe the bid-ask spread difference because there's always slippage problems. If you buy at 170 and you sell at 170, you're breaking even. So you're at zero. Well, let's say you go ahead and the stock goes up to 180. Well, depending on the amount of shares you have, let's say you go ahead and you're profitable right here. Well, now you might be profitable $400. And if that continues, well, let's just go ahead and draw a line kind of to the upside. Well, this now tells you, well, hey, if that stock is at 220, what's going to be my profit? I might be up at $2,000. Okay, and the same is true on the downside. Well, let's say that stock did not go in your favor, did not appreciate. Let's say the stock is having problems, bankruptcies, who knows, trouble in the neighborhood. And here, if the stock goes down to 150, okay, all of a sudden, you've now lost $800. Or it goes down to 140, right? You just match it up. You're down $1,200 because you were here. This is your start point, is right there. That's your starting point. And now, all of a sudden, hey, if things go down, well, you just match it up based on price and the number of shares right here. It's going to go ahead and tell you exactly how much you made or lost. Now, you could deal with this and understand this without a risk profile picture, but I think humans and we just naturally, people are, we like visuals, and this is a lot easier to see than trying to do the numbers, calculating it, making Excel sheets, and then going really crazy with it. So I think this is a better approach. Now, keep in mind that you can go ahead and change the steepness of this curve, which means you could change the risk, which many people don't think about, I guess. But you could have a slower, steeper curve, which means not only do you have less risk, right? You've reduced your risk, but that also means there's a trade-off. There's no gimmies in the market. That means, excuse me, that means you've also reduced your movement of profits, right? Your angle of elevation or steepness has been reduced. So this can happen and go with a number of different angles. You could really steepen it up. And it's just really because we're looking at it in one zoomed in view. Ultimately, what's changing is these numbers here. The stock price is going to be kind of the same, but it's really just the range of numbers based on the number of shares. So say, for example, this is maybe 100 shares, this could be 300 shares, and this could be like 800 shares. And because you have more shares, you have more risk, which means you lose money faster, okay? And you also make money faster, right? Because if you put in $10,000 compared to you put in, well, let's just put it over here, $10,000 compared to maybe $30,000, compared to maybe $80,000, well, all of a sudden, well, you've got more risk. For every $1 move that stock moves, it's a bigger risk. So this is really cool and fascinating when you start looking at the risk profile in your brokerage panel and platform. So let's say I went ahead and got shares of, let's pick a stock. How about, I don't know, you guys into Etsy? Let's see, or PayPal or Square. Let's say Square. Okay, this stock right now is $62 per share, right? So it's $62 per share. I put an SQ in my ticker symbol. There's Square, it says it's $62 per share. What I could do is right click, buy, and then right click, analyze trade. So I'm trying to go through it a little slower for you guys. So what you'll notice here is you've got a couple of things that look very similar. So here we've got our ticker symbol at the top, okay? We've got our stock price here at the bottom. Current price is right there, okay? So our current price is indicated by that little red hashtag, which you can't see at this exact moment. If you look at our profit and loss, it's going to be on the left. And our zero line is going to be right here. So this is our zero line. So as that stock moves up, let's say it moves over here, well, if it goes to 65, I match it up and it'll be roughly what, about $1,500. So what's cool about this program is you could just go ahead and move your mouse and you can see that right there, it'll go ahead and tell you you'll be up $1,500, okay? As I go and move it down, you can see my profit would decay or lose value. So this line right here, by the way, this dotted line represents the price slice. The current price is this little red hash tick, if you can see it, a little red hash tick. This line represents this price slice that's down here at the bottom. So what you can do is move this up and down by a certain amount, and you'll see that these numbers down here change. So if I want to see, for example, how much would I make if this stock goes up $2? Well, that would be my profit and loss right here. So what I want to show you here is really the steepness of this curve, this risk profile picture, because it's very interesting because all the risk that you do is based on this delta. Okay, this delta is your control factor on price. Now, you might not understand what delta really is. A lot of it we deal with in the options world, but delta is the amount of risk you have. Now, with stocks, it's really easy. If I go ahead and do 400 shares, I've got a 400 delta, 300 shares, 300 delta, 200 shares, 200 delta. And if I do one share, I've got one delta. So what does that mean? I've got one delta of risk, one delta of price risk. Well, it means that with one share, I make or lose $1. I need the stock to go up to make $1. So for every $1 move that stock goes up, I make $1, right? So here right now, I'm making or losing $0. So let's say we move this price slice up $1. So I'll go ahead and select up $1. So you can see it moved $1. And now you can see I made $1, right? Because I have one share, it appreciated in value $1. You made $1, or it's valued at $1. You still have to sell it and get out of it. But you know, if you have a cell phone that you bought for $450 and now you can sell it for $451, well, you have $1. So the other thing I want you to note is that I can go ahead and, as I increase the risk, look at this angle that these prices start going and moving. So I got 2,000, 3,000 shares, 5,000 shares. So you can go ahead and really steepen up this angle quite quickly. And then I can go ahead and stretch it, and it may now look not as steep. So I can go ahead and just kind of reset it. So even though I might go ahead and let it custom adjust for me. So if I go to, let's say, 60,000 shares, what you'll notice is just the numbers on the left change, but the angle hasn't changed. But if you do it kind of a fixed area and you start moving these share numbers around, let's say 15,000 shares, then all of a sudden, you know, it starts changing the angle. 900 shares, you know, it's less risk, right? You make less as the stock moves because you have a smaller delta, but you go ahead and also risk less if it goes down. But if you increase the risk, well, then you can make more, right? So in the same way here, if we're up $1 and we've got a delta of 1,800, meaning we have 1,800 shares, well, for every $1 move, man, it's whipping you around 1,800 up, right? 1,800 down, 1,800 up, 1,800 down. So what people don't get is they might buy a ton of shares. Now let's just reset this, and they might say, hey, I bought a ton of shares, 1,800 shares. That's why people love penny stocks, because you can leverage the share count. And now all of a sudden it goes up like $1 and you're up 2,000, and the next day it drops like $3 and you're down like 5,000. So that's kind of a little bit of a whipsaw action and effect that happens to some people. And that's one of the things that you want to be very careful about. So anyways, this is a risk profile picture. I think it's really powerful to understand. There's a lot of variations to these risk profile pictures that you could go ahead and do. And that is basically when you get into them a lot further, that you can do a lot of things when it comes to option trading with them as well. And you can make them look all kinds of different funky pictures. And I'll just show you here a couple of examples real quick. Let's just go to the board here and show you these examples. So when it comes to kind of option trading, it's a little bit more advanced. So you could set up something that looks, let's say, like this, an iron condor, which now you might say, well, what in the world is this? Well, if your price is here, it means you can have that range. You make this much money at a certain time, as long as that stock price stays between a certain range. The same thing, you might have like a butterfly. You might have kind of a diagonal, something like this. Or you might even have, like, let's just start out from something more simple, like a vertical like this. So what happens is that you can go ahead and create something like these different pictures where you're making money regardless of kind of stock price movement, or there's more factors involved in it. And what I can show you here is kind of a couple different examples on some of the things that I've been dealing with on the courses. Here's kind of an NVIDIA example. This one's 3 option contracts right here on one of the courses I was filming. So you can see here I've got 2 lines. One is the line at today. You can see this line is at today is the 4/24/2020 line, and that's at expiration. So, and our current price is right there. So you can see it's a live price, and you've got much more variables here. So when you're dealing with options, you're going to have like delta risk, gamma risk, theta risk, and vega risk, which basically, to simplify it for you guys, you've got price risk between these two, you've got time risk, and you've got volatility risk, which is way beyond the scope of kind of this video. But these are kind of the main risks that you have. Here's another example, QQQ trade, also very similar. Here's an example. And what do I have? Do I have any others? I think NVIDIA, QQQ. I think that's basically it for now. So anyways, those are kind of the basic risk profiles that we have. And let me know if you have any questions regarding this, because the next thing that we'll do is we're going to go ahead and get into compounding. So this will be kind of the next step. We'll talk a little bit about compounding, and let me see if I could go ahead and pull some things up for you guys regarding compounding. I think I have a nice little Excel sheet for that. And we'll pull it up. So let's just see if we have any questions regarding some of these basics first, and then we'll pull this off. Okay, Excel. Let's see. I'm gonna take a quick little water break. Okay, so here, when we look at compounding, I think, a lot of people are investing in things because of, you're looking for a return for retirement. And one of the things when it comes to the stock market, as we talked about with dividends, is you're looking for the compound interest effect. So what that really means is, let's say you go ahead and invest $1,000, then you go ahead and make a little bit of dividends. Then you can go ahead and take whatever you made and reinvest that money. And now instead of $1,000, you might have $1,110. And that now money works a little bit more. And then 1,010 goes ahead and, you make, again, a little bit more, a little bit more, and a little bit more. So it just continues to snowball. It's a snowball effect. And this is what happens is if you're trying to reach a certain amount, certain figure. By the way, this sheet that I'm going to go ahead and show you here in just a second, how long will it take to reach $1 million in the stock market? We're going to go ahead and send it out very soon to our people on our newsletter list. If we haven't already, I have to talk to my assistant real quick. But we're building out kind of a freebie section here, and just make sure you get on the newsletter list, and then we'll go ahead and email these once the freebie section is done. We're working on this part right now to wrap it up, but the sheet is basically done. So a lot of people wonder, how long does it take to reach $1 million, $2 million, whatever the case is, whatever your number is. So what I did was I just created a simple Excel sheet that you can go ahead and use it to calculate your target goal. It might not even be $1 million. It might be 200,000. You might have $100,000. It doesn't really matter. Whatever your goal is, you could go ahead and use this calculation to give you some idea. And what it really focuses on is your age. So let's say you're a person that is 10 years old, and you might have a SEP account or some kind of account where, you're maybe trusted in it from your parents, and they started investing for you. And maybe your percentage of return is, let's say, 3.25%. It's not really that aggressive or anything like that. And your starting balance is $5,000. And you contribute only $500 every time. Well, what this does, this little Excel calculation sheet, is year one, so that's the first year, age 10, your current balance is $5,000. Balance with contribution is going to be the same because you've contributed that $5,000. And your return, let's say 3.25%, you're going to make $163 on your return on investment, right? I went ahead and got rid of any decimals there. So your final balance will be $5,163. So this is where the power of compounding takes place. So we go ahead and we take this $5,163 and we put it back into year number 2. Okay, so now you're starting with this balance. And remember, you're contributing $500. So now you add $500 to this balance. That'll give you $5,663. And you go ahead and now add, here's your return. And you add your return and you're going to get $5,847. And this process kind of continues further and further. So if you're age 10, and we just went ahead and I filled it down. If you're age 10, you're making 3.25% return on investment, starting with $5,000, which again, your parents probably put it in. And then you go ahead and contribute $500 every single year. And how long does it take you to reach a certain goal? Well, let's say you want to save for college or something like that. Let's say you're age 21. Well, what are you going to be left with? You're going to be kind of around $14,000, right? If you kept this pace up. How about age? I mean, this is all linear, right? It's not exponential because some returns are going to be more or less, but it just gives you an idea. But it just shows you the power of doing this. If you're only contributing $500 and you're only getting 3.25% return, it takes a while to reach, here's $500,000. You got to be age 112. That's a long time. So basically it's saying you got to bump things up. So if this target figure is too long, well, you need to contribute more. And $500, well, that could be, hey, if you spent $25,000 on a car, well, let's just say spend a little more on your investments. So let's say you're contributing now $2,000 here every single year. And let's say you're starting at age 20. Okay, so here, what's this going to look like? Well, now if you want to go ahead and, because now you're contributing $2,000 a year, which is still not a ton for a working person, right? Of course, $2,000 can be a lot of money for anybody, but for a person that's working actively, you should be able to do that fairly regularly. And now you can go ahead and see, okay, well, how long is it going to take me to reach that $500,000 mark? Well, it'd be 87. Is that good enough for you? I don't know, but it gives you an idea. And compounding, what it means is that you're just adding things onto it. Like, if you're making a higher return, they say the average market kind of 8%, sometimes 12%. Sometimes the other year you had 20%, but then you dropped like 30% this year. So you're mixing and matching what's going on, what's happening. So maybe, let's say you're averaging 8% return on investment and you're putting in, let's say, $5,000 every time, and you're starting with $25,000. Well, how long does it take you to reach those things? All of a sudden, with an 8% return, you start to ramp things up fairly quickly because you've got a balance here, okay? Annual contribution of $5,000. So your return is basically $2,000, and this doesn't really take into account too much dividends as well, because remember, dividends is a little bit more of a bonus on top of that. It doesn't take into account appreciation. This is just a general guideline for basic stock market return. So if you've got a stock that appreciates like 37% in a single year, this won't work. We're talking about just basic, like an ETF investment here. That's all I'm talking about. It's like if you put your money into the SPY, IWM, something like that, you're looking at roughly 8%, and that's kind of where we're at. But if you've got like dividends and good dividend paying things, then this might be even higher. So in either case, looking at age 20, you can see we go from 25 to 27. So the difference here, right, the spread, we're looking at 5, 6, 7, 2,000. Then all of a sudden, here the spread is way bigger. Then it's even bigger. So that starts to ramp up and accelerate. So if you're looking to make, let's say 500,000, you're done by age 45. And that's just starting with 25,000, $5,000 contribution, and you're good. If you need more, and let's say you're starting later in life, let's say you're starting at age 50, well, all of a sudden, age 50, you're going to be there with, at age 75. So you have to bump up your contributions, maybe, let's say, $15,000. And now all of a sudden you can go ahead and maybe get that $500,000 by age 66. So in either case, this is a nice little worksheet for you to kind of look at and play with depending on what you're making. Even if you're actively trading, this gives you an idea. Like let's say if you're active trading, swing trading, day trading, option trading, and let's just say you're making like 24% return on your investment. Well, this gives you an idea of, okay, well, what can I do? Maybe you're only contributing like 5,000, but if you're, doing 24%, or let's say 16%, because you're beating the market, then it just gives you a rough idea of what what's possible, or some figures for you based on your past history of trading and so on. So I definitely look into compounding. This is where the power's at. This is where you grow your nest egg, your retirement, and make I guess the most from the compound effect, because you're reusing your funds. Okay. So that sheet, by the way, again, you can go ahead and check it out at our website. We're going to have it up very soon on the freebies section at tradersfly.com. I'm also going to have it probably on the My Little Nest Egg, which we just finished up the website. If you go there, because we're doing this website, all the stuff that here is on this channel, we're going to keep it really simple, really basic, real personal financial things. So it'll probably be in the freebies section very soon. So anyways, my main goal here is just to go back deeper into the roots for people just getting started with things, because I think a lot of that is left out. So anyways, let's go into our next section. But before we do, if there's any questions, please feel free to go ahead and submit them, and then we'll go ahead and take a look at those questions and make sure we're answering them. We're going to go into reading some charts. I think this has been a strong suit of mine that I really focused in a lot on when I was doing a lot more day trading and active swing trading. I think for a lot of people that are just basic investing, they don't have to focus too much on charts, but I think it's important to understand how these charts really work. And I'm going to keep it real simple for you guys. You don't have to make them that complicated. I think a lot of people overcomplicate it. They get too much zoomed into the little details of, hey, let me check out this tree. Let me check out this indicator. Let me check out what's happening with this bar. Oh no, the stock's going up, the stock's going down. So it becomes a big issue and problem when you start doing that, because you don't see the bigger picture and the bigger perspective. So anyways, let's go ahead and take a look at this and evaluate kind of some charts. So when you look at charts, and I'm going to go ahead and show you my platform. I use TC2000. This is a basically, if you want to go to our website, you get, I think, 20 bucks off. This is a paid platform, so I think you can also get it at freestockcharts.com for the free version with some ads and things like that. But there's many charts out there. If you search on Google or anything out there for like McDonald's chart, they will give you a chart, but it's not as detailed. So this is kind of like a line chart. There's many other charts out there. If you go to finance, you'll get kind of a little bit more of a detailed chart, I believe. Here, let's see. I think Yahoo is kind of the Yahoo, finance, McDonald's. I don't know why. Finance, let's see. Yahoo Finance, all. There we go. Symbol lookup, McDonald's. And if we look at the chart, I think this was kind of the best free news stock chart that I saw before. And what you can do is you can change this chart from a line to an area. There's different kinds of charts. You can go to a candlestick, which is typically what most investors look at. There's hollow candles. I personally like the bars, which is actually this, and it may look a little weird and funky, but I like it over the candlesticks, just me personally. I don't record video that way because it's a little more difficult to see, so you can even see like, hey, I zoom into things because there's always people that are a little older with worse vision. And, so I try to make things as clear as possible in my videos. But I like this version the best, and it's the same thing when you look at candlesticks, because what this does is when you look at something like this, the stock opens at this price, wiggles around up and down, and then closes at this price. So it tells you exactly, opens here for this candle, wiggles around, hits the lows here, and closes at this price, so it closes lower. So I find this is a lot easier to read personally, and it's just like kind of an input, wiggle, output, input, wiggle, output. So that's the way I personally look at things. But a lot of people, what they do is they actually look at more kind of a candlestick, which is something more like this. And in either case, what the point of these candles is it tells you, they used to use rice grains or to measure rice in Japan with these kinds of things. It just tells you the daily action. There's more insight and knowledge behind this than just a line chart, right? A line chart plots the final point, whereas this will plot the day action. And you can get not only just the day action, but you can get, let's say, in 5 minutes. What happened in 5 minutes? Like each bar now represents 5 minutes, or each bar represents kind of 30 minutes, or the day, or the week, or the month. So now every bar represents the month. So you can see if I'm looking at GoDaddy, every bar now is a month. And here's our time frame. This is how charts really kind of work. You have time is one of your basic axes. So you can see here we have 2015, 2016, 2017, 2018, 2019. And then you have prices on the side. So basically you match up the time. If I'm looking at 2017, I draw that line up and I look at the price. Well, what was the price? It was right around about $37. And here with some charting platforms, you could go ahead and click it and you get like this box at the top left that you might see right now. And your high there is, you can see the high, the open and the low, and it gives you a couple other details and information. So this is kind of the basic point behind the charts, is that a chart, just like we talked about risk profile pictures, gives you a visual representation. Here you could see we kind of went up and now we're kind of moving a little sideways, or if you want to get a little more technical, you've got this little channel that's moving there. So you've got this acceleration and you're pulling back. So if you invested in GoDaddy way at the beginning, you'd be a lot higher at this point, and you might have bought things at $30 a share, and now you could get out at about 67 a share. So in a way, double your money or so. So if you put in 10,000, you'd be 25,000 or something like that. So in these charts, they tell you a couple of things. So just like before, you've got your ticker symbol, you've got your time frame, you've got the movement for that time frame or for that last day. You've got the axes for the date there on the side. You've got prices on the vertical axes. And on the bottom, you could go ahead and add in other things. Typically, there's volume there. So that basically means how many shares were traded. And the more shares that are traded, the more power or gas you're stepping on in the time frame. So if I look at kind of the day-to-day operation here, you could see that some of these have larger volumes, which means a lot of people were going in. And was it going in on the sell side or going in on the buy side? Here in this case, it ended red, so there's a lot more sellers, so it took the stock down. So that's what kind of green means. Green's like higher, red is lower. Other things is basically this is kind of the wicks. And when you're looking at just overall the range of what this means is you got to think of this as like breadth. You know, if you think about it like breadth, you don't have to learn too much about these candlesticks. You know, I know there's like different names, dojis, shooting stars, graveyards, you know, but for me, I look at it as breadth. And if you think about it like a breathing, organic movement, you'll be light years ahead of most people that try to learn technical analysis through books. And that's what I found is that analogy works for me the best. So if I look at just the breadth of, let's say, I back this up and just explain it real quick. You know, think of this right here is short, soft breaths that you're struggling to get air. You're struggling because it's short and it's going down. So you're struggling to grasp that air. And then this big bar is really damaging because it's strong. It's a lot of pressure, and that means you can't get air. On the other hand, these green bars, you're breathing heavy and you're getting that air and it feels good. It's like you're running. So it's like, you know, and when you get that, that means, hey, people are buying into the stock. They're, oh yeah, they're getting into it. So when you're starting to see that difference, that's really the way you want to look at these kinds of things. And if you're looking at, let's see, who do we have that tanked? Oh, let's go to Boeing. Boeing tanked quite heavily. Here is kind of our weekly movement or weekly graph. So you can see the breath overall was kind of, you know, subtle breathing. Or you could say, hey, maybe it was breathing normally. You know, you had some inhale breaths, some tough breaths. But then you started to really ramp things up. Oh, I'm suffocating. Can't breathe. And then again, it just can't breathe. The stock is dying. It was dying. And then eventually, caught its breath, got above the water, you know? And that's what, you know, the stronger that move is, the more the breath, the stronger the move. And that's what relates to volume. If you had a small pop here, small breath, after you got out of the water, that means that stock is still dead. It's still dying. Because you might have seen this, like if you look at kind of this daily action, right? So we've been moving down, and then you get these little breaths. It's not enough, right? It's not enough. And then eventually you get larger moves, so that's a little bit better. But then when you get this sideways, you know, your breath is kind of stable, but you're barely above water because you just were out of air not too long ago, so you're still trying to play catch up. And that's what I want to share with you is that when you're just coming above water, or if you just ate a Chinese buffet or any kind of buffet, all of a sudden you need time to digest. You need time to reflect. And that's the thing with these stock charts. So anyway, hope that makes sense. Gives you a good idea for an analogy of strength. Do you need a lot of indicators? There's a ton of indicators you could put on here. I just put 20-day moving average on the volume. Typically 20 days is what a lot of other traders use. That is 20 trading days in a month, right? Excluding weekends and that kind of thing. For most investors, I would look at more the weekly and the monthly, especially if you got a day job. Monthly is good. So if you're looking to invest in anything, I don't know what you guys are looking to invest in, but let's say you're looking to invest in EA, Electronic Arts. Well, what you could do is you could pop in a moving average. So how does that work? Well, what the moving average is it takes the price of each one, adds it up, and plots the point. So here's, in this case, we've got a moving average of, this is kind of the 10 day, I believe, or the 10 week or the 10 month, depending on the time frame. And it plops the point right there. And then what happens is it takes the next 10. So if I had the 10 over here, and now it plops the point, then I do the next, go to the next one, for example, then it does the previous 10, and then it plops the point. So it kind of gives you an average. So just to show you, here, let's go ahead and edit this. So I've got kind of a 10-month average, but I could go ahead and go a little longer. So you can see it shifts. And let me go ahead and make this line a little thicker. So here we'll do, let's see, what can we do? Can we do a regular line? There we go. So what I could do now is go ahead and let's make it yellow, stand out a bit. So what I could do is go to 20-day. This is kind of a 20-day. And then the 30-day, as we go there, it's more smooth, right? Or the 30-month in this case. Then you continue this process, 40, 50, and so on. Now, in this case, you got the 200-day is what a lot of traders use, but in our case, this is a monthly, so it would be more like this. 200-day gives you kind of a longer term perspective. So if you're looking at a stock, well, how's it doing? You might want to look at this and say, hey, well, are we trading? How are we trading? We're kind of moving up, then we're kind of moving down, and then we're moving a little sideways. Well, as I look to be a long-term investor, if we're way above this level, right? If we're way above this moving average level, it's probably going to pull back. And that's what happened, right? Overstretched, pull back. Same thing, overstretched. Yeah, good times roll, but then you're going to come back. And sometimes you get overstretched to the downside. Well, probably come back. And look what happened. It slowly starts coming back. So that line kind of sucks things in because you're averaging all the recent prices. So, putting these kinds of things on to look and evaluate stocks like a Caterpillar or let's just say Baidu gives you a longer term perspective. Here's lows. So you can see, okay, it's kind of been moving at an angle. And this is what I would recommend you do. Okay, well, where's the earlier point? Where's the current point? This is kind of your range of return. This is the angle that you'll be making money at in general. Now, for the long haul, right? This is from 2015 to 2020. Yes, you do have some pullbacks in that case, but overall, that's your angle. That's your angle of elevation that we talked about. That's kind of what you're making money on a per share basis. If you look at kind of, here is waste management, right? That's not going away anytime soon. So here's kind of your angle right there. Okay, so a little bit of a steeper angle. So here's kind of my horizontal line. So you look at that angle. If I go to JP Morgan, okay, here's my angle. Here's this right there. You could draw it, and there's that angle. So does it really make sense to go ahead and try to stock pick completely? I usually don't think so, because you look at some of these angles, they're fairly similar, with the exception of once you hit something like this. So here we've got kind of our low point, and then here, and that would be the rate of return. So you can see that's kind of light, and especially now you're way down here. Again, you could kind of look more at the weekly, and now you're looking at like a 20-year horizon, but that's a long time. So if you're looking at a day-to-day recently, here's kind of a 5-year range, and that's what it's been doing. And if you look kind of a 2-day, 3-day, you might even look at something more along the lines of, okay, now it's actually more like this, but that is a longer time frame. So what does this offset mean in time? Okay, so Righty here asks a question. What does this offset mean in the time? Okay, so what it means is it's offset when you're looking at a moving average, right? So let's say we're taking this 200-day moving average, and let's make it blue this time so I can use yellow. You're offset by a period of 200. Are you talking about the offset in the panel right here, or are you talking about the period, how the line is offset? I guess I'll talk about both. Offset means you could go ahead and shift it a little bit, and you can see it moves. So basically, instead of the last 200, it's really 220. So that's the first thing if you want to do offset. The second thing that we're looking at is when we're looking at the line itself, if it's above it, that means it's moving faster than the average. If it's below it, it means it's moving slower than the average, right? So it should have been, the average should have been way up here, but it's way below it. So if we look at, let's just go Harley Davidson, not one that I watch too much, but it's got some sideways action. So you can see here, if we go to kind of a, let's go 3-day, gives you a good idea. So 3-day chart on a 200 moving average, normally you would use 200-day moving average. I'm just using 3-day as an example. The further it is right here, it just means it's above the moving average. It's moving faster than the moving average. If it's below here, it's moving slower than the moving average, so it should eventually catch up. So that's why things would get overbought, overbought or oversold. So they're probably overbought over here, oversold over here, stretched, and so forth. All right. Okay, why would someone want to use, okay, so here's another question. Let's see. Okay. Why would someone want to use the offset? Okay, if we're looking at the offset of this, it just means, if you're looking at this as trading signals, because that's what really happens, is when we look at the plot on a daily, and let's just say we're looking at a 50-day moving average, and I go ahead and let's just change this a little bit. The whole point behind offset is that when you look for, and this kind of goes along with our selecting some trade ideas and keeping it simple. What I normally look at people that, hey, if you want to keep it simple approach, let's say we go to, let me back it up. Let's go to the 200-day. If you want to get into this stock, what some people want to do on a longer term and you got a day job, you get in it when it breaks above it, and then you get out of it when it breaks below it. So you made this move, and then when it gets back above it, you get in it, below it, out of it. Back above it, get out of it. So you can see you had kind of one good range here in this case. Let's check another one out. Let's say Twitter. Okay, we get in it when it breaks above it, we get out when it breaks below it. So what does this mean? Well, it means that you have a certain amount of trade signals. So if you're looking at trade signals, and here we break below it, so if we're looking at trade signals, I may want to offset this line so that way I get more or less trade signals. So in this case, let's say we've got 200 or even let's say 100, you can see you'll get more trading signals, right? As you go to a shorter duration, you'll get more trade signals. So let's kind of back up here. So you can see you'll get way more trading signals above, below, above, and kind of, well, still above, below. So what you might want to do here is offset it right here, and I'll just offset it by, further. So now you don't get fake signals. So you offset it by like 10 or 12 or 5 or whatever. So it just gives you a little more, I guess, safety net. So that's one way. Hey, you're welcome. Makes sense? Perfect. So that's one thing you would probably do. Other people, what they do is, you can see I have a simple moving average. That's the one I use. I just keep it simple. There's also exponential weighted averages. There's many other ones, which basically puts more weight towards, you could say also front weighted, hull weighted, is basically exponential weighted averages is just saying that, hey, probably the more recent price movement is more important and more valuable. And if that's the case, well, we'll put a little more weight to that. So anyways, we're not going to get into that too much right now, but you could go ahead and look at some of these things. And you can see here is our exponential, here is our simple. So actually, let me duplicate this. Edit, we'll go to 20, and we'll go, this one we'll make yellow, and we'll do kind of dotted and simple. And let's see. Okay. Let's see if I can. I don't know why the line's not showing up, because I have some of these that basically, because it's so close, I got to make it thicker. And let me see if I make the other one a little less opacity, and we'll do more like this. So it's tough to kind of see, but here let's do maybe 50 on this one, and 50 on this. So we've got one simple, and this one we'll do exponential. So you can see here, one is simple, one is exponential, and it'll just give you a little bit. You can see that the exponential one will follow right here the movement a little bit closer, not a ton, but a little bit more so than the simple version, because it tries to put a little more weight there. So anyway, okay, so we kind of went into some chart reading things. When you look at charts, they kind of behave with that mindset of a group mentality. A lot of people wonder, hey, why do I want to look at charts versus analyzing a company on the fundamentals? Because you could go ahead and look at a company fundamentals. If I go in and look for, hey, McDonald's sales in 2020, you could look at a lot of reports in these cases. There's the 10Q, the 10K. There's historical data, let's see, financials, so you can see, hey, how much money are they making? So a lot of people dig deeper into the financials like this. So this is kind of evaluating stocks based on fundamentals. This is what typically Warren Buffett does that most people look at, because he's looking at, hey, how's the company operating? What most people don't get is that when you have a good company with good fundamentals, you'll probably have good charts. And when you have companies with good charts, meaning good movement, you'll probably have good fundamentals. They go hand in hand. Can you use both? Yeah, but do you need to? No, not really. Just whatever one you're comfortable with. I think for most people, these financials are way more confusing than charts. I think charts for most people are easier. It's just what I've seen with experience after working with people. The charts just make more sense. How fast is the stock moving? That's what they look at, and it makes sense to them. That's fine. And then they just check out the dividend. Okay, great, I'm good. These financials, to understand products, what's the shipping, what's the delivery expenses, income before taxes, income tax expenses, income from continuing operation. People that dig deep into this are usually really analytical people, and it's fine. I don't blame them. They love it, and if it makes sense to them, fantastic. But you got to understand that sometimes these companies, they cook the books, not in the way that, not in any illegal way, but what I'm saying is they forefront products. So say, for example, like certain companies, they go ahead and say, hey, well, why don't you, like let's say stores, why don't you, a maker of, let's say, what do we have in there? Chicken, frozen chicken. Why don't you pre-send us another caseload this month? So Walmart, you go ahead and order an extra pallet of chicken from our whatever chicken fingers, and you can go ahead and keep it in your freezer because they're good in the freezer for 6 months to a year. So go ahead and order that extra pallet this month because we need to make more money on our books this quarter because our financial reports are coming out soon. So that's what they do, is they've kind of front load it, or they advance order it. So that way they can get the money from Walmart, and then they can go ahead and put that on their books, and it appears like they're making more money. But it really, what they're doing is they're doing that, and they're constantly playing catch up, right? So come whatever, earnings season 1, then they go ahead and bump that up, and they try to, hey, hit a certain profit target. Then they come earnings season number 2 or quarter 2. Then again, they're now even more behind, and they try to do that. And then eventually, hopefully they catch up, but it's a never ending catch up kind of game. So what you need to understand is that if you're looking for like not dividend, but if you're looking for earnings per share and you're looking for things that beat earnings per share, you're looking for typically quarter to quarter. So let's just go ahead and look for, here's our quarterlies, and we're looking for, let's see if this has it. I would rather just look it up, earnings per share or earnings. You could do it in your panel. Again, I'm just using McDonald's. Earnings last quarter, McDonald's, and they kind of give you the earnings per share for every share that's there, right? They give it to you. The reported was 1.72 last year. So when you compare it, you want to go quarter to quarter. And that's basically saying, hey, I want to compare the Christmas season to the Christmas season of last year. I want to compare the let's say summer season to the summer season of last year. So that way you can see, is it growing or not? Because if you're comparing Christmas to summer, that's kind of two different seasons. Because some companies, what they do is they have a really good Christmas season, but really bad summer, or they make 90% of their money Christmas time. So that's why you'll see a lot of that comparisons there. If you're looking at like platforms like this, they will typically give you the dividends report and the earnings. So you can see here in these little areas, here it tells you earnings per share 0.618, estimated actual was 0.52, and the stock kind of went down just a little, but then it continued. So again, just because it has a bad earnings doesn't mean stock price is going to go down. Here again, estimated, actual, and so on. So my point is that can you work with fundamentals? Yeah. Can you work with charts? Yeah. Either one will be fine. I think for most people, the charts are a lot easier. And when you start looking at these, you'll notice that they create patterns because the charts mimic human behavior. Human behavior, when things get oversold or too much, they say, oh, this is a good value. I probably want to buy some. Or it gets overbought. Oh, man, I'm making a lot of money. Maybe I need to sell some stock so I could go ahead and buy my next, whatever, cell phone, goodie. Hey, this is a lot of money. I take some profits and reduce my risk. So what this does is that when we look at these things on these charts, and let's just go ahead and get rid of these moving averages. Again, I don't really use these too much, but I do sometimes just kind of keep a hand on maybe the 20 or something along those lines. And again, I just keep it really simple. So anyways, so what you might want to do is, as we look at kind of stocks, and you're starting to look at things, you're looking at where a lot of the base is, kind of where are people holding the stock up. So you can see here in Nike, there's kind of a huge base here. So you're just looking for patterns. And what I recommend for most people is just to go ahead and look at sideways price action. You know, you can look at a trend, which is kind of like more diagonal, up or down, or sideways. And that is really it. Keep it simple for now. And if you get a little more advanced, you could look at other things like the candlesticks, the breadth of it, more so. You could look at other technicals like chart patterns, which is way beyond the scope of this video. Again, if you want to look more at technicals, check out the course here. And we have how to trade stocks with technical analysis. It's really in-depth. I think it's like 10 plus hours of trading just on charts. So anyways, when we look at these kinds of things, you're really looking at kind of the range here. So we've had a couple of swing or position movement where they change direction and kind of hold steady right here down here. And the same thing here, you got a little bit of resistance. So anytime it rejects things, that's resistance. Anytime it holds things up, that's kind of like support. So you've got support over here. You've got resistance over there, and you can find this almost on any stock. You've got our channel, so you just kind of do this in a diagonal way. You got a channel right there. So in the general movement, the resistance, a diagonal resistance right here, you're just connecting two dots, and a diagonal kind of support. Again, connecting kind of a handful of dots. They're not going to hit perfect. This isn't, this isn't engineering or math school. But they will go ahead and kind of be in that range. If you look at Starbucks as well, again, you're looking kind of for the swing lows. And let me just go ahead more in the monthly, because it's just a little bit easier to see. So you can see here's one point, there's a second point. And for me, my eyes just kind of see it. It already connects, and then stocks break out of resistance. Okay, so you've had kind of a sideways area and then movement. So you got resistance here and support down here. Okay. All right, so got a question here. Let me go ahead and pop in this question. Let's see if it'll work here. All right, so question is, let's see. Hey, Sasha, what software do you use? And the software, this is TC2000. You can go ahead and, if you're interested in it, this is a paid software. You can go to, I think, stockbrokers here, TC2000 by Warden, and I think you get a discount with this coupon or something like that with that code. It's also an affiliate link as well, but that's the one I use. They also have freestockcharts.com. The broker panel that I typically use for trading and for teaching is Thinkorswim, because most people have it, and it's the most flexible platform, and it's the easiest one to teach on as well. So I find that's a good teaching platform. So that's kind of my thing that I use, these two main things right there. You don't really need much more than that. If you're interested in some other stuff, I think there's also, let's see here. There's equipment and tech that I use, some books that you may want to read. Check that out there. There's also tradingview.com for charts. So there's a ton of them out there. You also have Webull. They've actually been reaching out to me quite a bit recently. I think their charts are also quite good. So in either case, right here, Webull, also very good, is a highly big competitor to Robinhood. Tastyworks, also very good. Tastyworks has actually the guy, Tom Sosnoff, invented the Thinkorswim platform. So I was on the Thinkorswim before TD Ameritrade bought it. And you've got Tastyworks as well, which we can get into brokerages here a little bit later. And so forth. So let me just answer this one quick question right here. I think we've got another comment here. Let's see, also by Righty. Okay, so this question states, okay, if we go in and we go, let's see, what is the best platform for options? Robinhood versus Tastyworks versus TD Ameritrade. I think TD Ameritrade, you'll get more goodies, and Tastyworks as well. I wouldn't touch Robinhood at all for trading, not for active trading. If you have passive investments to buy shares, I would go with Robinhood, it's fine. But I wouldn't, for options, I wouldn't touch Robinhood. And that's just because they don't have risk profile pictures. And you can't call up anybody. If you need, I'll tell you, because when you're dealing with portfolio margins and you need to talk to somebody, I'm not worried about people, you know, the $1 trade for the commissions. And Robinhood, what they do is they funnel trades to their buddies. At least that used to be the report. I don't know if maybe they changed it. But think about it. If you're trying to get into a trade, or you're trying to go ahead and buy bananas, right? And you're trying to load up your grocery store, but you go to your supplier and say, hey, my bananas are $55 per banana. And you say, I need bananas. Well, your contract states you got to buy bananas from them. Okay, when the other grocery store is 89 cents a pound. And what Robinhood did was they would take their buddies, right? So you got your buddy over here, or you got different exchanges. So you got your Robinhood broker. You know, I know a lot of people love it because it's a marketing thing. Free commissions, nothing free. So what you have stocks trading that different bid-ask spread, right? So you might have a stock that's trading at 89.35. You got another stock that's trading, same stock is trading at 89.15, and then at another, the way they route the trade might be at 89.05. Right? Maybe the spread is not that big of a deal, but what Robinhood did was they would go ahead and route it, like when you buy the stock, they would route it always to their partner. If that's their partner, they would always route it there. And sometimes you're paying higher price per share. So you might think, hey, I don't have to pay the $5 per trade. But if you're buying a ton of shares, when you could have got it routed through the best exchange, you're saving like 20, 30 cents a share. And that starts to add up. So most people don't get that. I talked about that before, but I don't want to bash them or anything because I think they're fine for just basic investing. And for a lot of people, it's easy to use. But understand, there's nothing that's free in the world. Like, it may sound good on the surface, it's not free. So understand what's happening and how they make their money. So anyways, my point being is software-wise, Tastyworks I think is great for options. TD Ameritrade also great. And the whole point behind it is the profit pictures here that we talked about right there. So I think that's very key on these profit pictures, is that you want to see those kinds of things like the NVIDIA, and you don't get that with Robinhood. You want a good platform. You don't want it to be on the phone. You want it on a computer because it's more powerful. It's easy to see. You can put your orders in. But again, that's just my take. So anyway, moving forward, I think we've covered quite a bit on the charts. So looking at these charts, just a couple of quick points. I'll just go through a couple of things here, like GoDaddy. So I'll just draw some quick support here. We got resistance. So you can see we've got support and resistance at these levels. And you're also looking at the volume. That's just telling you the speed of things. Let's take a look at other ones. And normally you would want to look at a monthly or a weekly chart here. Because if you're looking at a monthly or weekly chart, you don't get those fake signals. So again, the same thing. You're looking, hey, here's my support. Here's kind of a little bit of resistance. It's trying to get back above support. And the same thing here. You can see the stock tried to resist. 1, 2, 3. Oh, I can't break through the ceiling. I can't break through the ceiling. I can't go higher. I can't go higher. So it moves. They move in these different ranges. Here is a square. Same thing. Keep it simple, horizontal. You don't have to make it too complicated. Right there, there's your resistance. So you can see if you want to go in, here's Tyson Foods. Funny, we were just talking about chicken. So here you can say, okay, well, do I want to look at things like in a trend? So some people look at a trend, but then the trend gets broken. So that's why sometimes you'll overlap things, or that trend slowly changes. So you got like an initial trend, and then you've got kind of your support levels there too that you're watching. So you'll start to oversee things as you get deeper into certain patterns. And I would say, if pattern doesn't look right to you, if it doesn't look good, don't worry about it. Don't trade it. You don't have to invest in it. Nobody's forcing you to invest your money. Keep it kind of simple. Here's TD Ameritrade, by the way. And by the way, if you guys trade a lot, you can easily call up these brokers. I know now they lowered their fees, but you can easily call them up. And let's say you're trading 1,000 to 2,000 contracts a quarter. They will lower your rates. Same thing with stocks. They will lower your rates, but you got to give them volume, right? It's kind of like, hey, if I send you business, if I give you $20,000 worth of business to your printing company, are you going to give me a kickback, or are you going to give me lower rates or better rates? Because I'm sending you a lot of volume. And yeah, they will. So that's just part of dealing business. So you got to understand what's happening underneath the surface, because they don't just make money on their trading fees. So anyway, so that's kind of the basics there of chart reading. You can go in much more detail there, and there's just so much to kind of cover in that section. So the next thing I kind of want to take a look at is portfolio allocation. We'll take a look at how much money to put into different stocks or different investments, and how much kind of to keep on the side. Again, I'll give you a general approach to this. So I'll give you kind of my personal opinion. Again, for you, it might be different. So I'm not your financial advisor. I don't know you personally. I don't recommend anything. So all of this stuff is just ideas for you. So I want to go ahead and give you some ideas though on a portfolio, and just for a general person that I would say, hey, here's my brother, here's my cousin, here's my good friend. What would I tell them if they got a stay-at-home job, or they're working, they got a regular day job, and they just want to put stocks on and kind of set it and forget it? So here's what I would look at is, when we look at stocks here, and we're looking at a basic approach, okay, so, and we're looking at a portfolio allocation. Sometimes it can be too much. You might see some things in forms where I've got, let's say 150 dividend stocks, but how many shares of each, right? Other people might say, hey, I've got 2 stocks. So what's the range that's kind of healthy? Do you want to have, 2 stocks or 150 stocks? I would say, a sweet spot for a lot of people is probably more in the range of, and this is just by the sheer fact of management, is somewhere 5 to 8 positions at most. So if you have too many, it's much more difficult to hedge and protect yourself. So 5 to 8 positions. I think having 150, you're getting pointless to the point of, you could just invest in the SPY or something like a ETF, VNG or Vanguard ETF, VGN. We'll take a look at it in a second when we get more into future things. And here, 5 to 8 positions, because if you've got, let's say, a position of SPY, a position of McDonald's, a position of Nike, a position of EEM, which is the emerging markets, and a position of TLT, that's already 2, 4, 5 positions. Now, you might not know what this is, but this is the 500 stocks basket. This right here, McDonald's is a burger company. Nike, kind of shoe athletic company. EEM is emerging markets, so this is like outside US markets. TLT is the bonds. So now, so this is treasury, and you could do GLD, which is gold. So now you've got 1, 2, 3, 4, 5, 6 positions. Is that enough for most people? I would say so. And I'm at, only 6. Some people say I got 150. Well, they just like to collect things, I think, which is fine. If you want to collect things and that's an interesting way for you to kind of stay stable to where you're not constantly moving or losing or taking money out when the market goes bad, that's fine. You can do that. But otherwise, I wouldn't get too bogged down in having more positions. I would rather be more diversified kind of in this perspective. And you don't have to have gold, you don't have to have bonds. You could still be very diversified just with 2 stocks and an index. And I'll show you how I mean, or what I mean by this. So when we're looking at kind of this, it really depends on the amount of shares that you have. So if I look at one type of share allocation, let's say you have 100 shares of this, 50 shares of McDonald's, and 50 shares of Nike. Well, all of a sudden, how much weight do you have here? It's kind of like the return, excuse me, the return on your dividends. Well, what if I go ahead and flip-flop? What if I only have 10 shares here, 150 and 150 here? Well, am I putting more weight in one versus the other? Yes. So now your risk starts to shift and move around. So just by having 3 different positions, you could shift the risk in a whole different way. Whereas here I might be balanced on 2 of them and have way heavy risk in McDonald's. And here I've got heavier risk maybe on the stocks, but not as much on the index. And here I've got heavy risk on the index. So just by the sheer fact of putting the amount of cash and capital on can really shift your risk. And that's the name of this business, is understanding the risk that you're going to have in these trades and in these positions. So you don't need to have 150 positions. Just having a handful is a lot easier to manage. It's kind of like having 5 or 6 cars. If you've got 5 cars, well, each car needs an oil change. Each car needs tires. Each car may need some kind of maintenance work. And the same thing here. You're watching the positions. You're watching them. What are you going to do when things go against you? So having more positions really creates a bit of a problem. Not to mention, I guess, a ton of tax thinking and consequences depending on how much in and out you do. I don't know. Really, in the end, it's not too bad because it's all automated these days. But just on a personal level of typically humans on the psychological capacity just do not have the mental capacity of dealing with so many positions. It's kind of like name your name 50 fast food restaurants. You probably name, 3 to 5, but once you run out of ideas, the human brain doesn't store all those things. Have you probably heard more than 20 or 30? Probably. But the thing is the mind doesn't, because it's not as relevant, because by the 3rd or 4th choice, it's already good enough, or it's enough that you've kind of had. So anyway, so when we look at portfolio allocation, what I would look at is, where do you put more weight? So do you put more weight in your positions on kind of an index or kind of in a stock? So again, if you want low risk versus high risk, and again, there's medium risk as well. But what you do is, just like the basic drawings here, you could go ahead and have low risk where, hey, I have here is more kind of a ETFs and diversified basket, and here might be stocks. Now, this is kind of typically more, let's just say 50 and up years old, but you could still have a 20-year-old that wants less risk. Why? Well, hey, maybe they just got out of college. Maybe they got some debt. Maybe they just don't like a lot of risk. That's totally okay, and they're risking more in business or other things. And then what you have the other way around is maybe you could do something similar. You could do maybe more stocks where you have heavier risk. You could do even, let's just say, penny stocks where you're higher risk. Okay. And maybe you're doing even more some with options. I don't know. It just depends on who trades what. That could be less risk. Depends on what you do. And then the rest you could do kind of with an ETF. So this is more of a higher risk setup. Again, I don't know you personally on your experience, but of course you could even set up ETFs where they are still high risk, depending on the position or structure that you set them up on. So when you look at this in this way, what you typically will see is that people graduate from, let's say, low risk or from high risk, and they go to low risk. So when you're kind of 20 years old, you have kind of a higher risk. Then you get into a lower risk as you get older because you don't want to lose as much money. You don't want to, basically, you want to preserve wealth rather than grow wealth. In this case, you're focused on growth. In this case, you're focused on hold on to your money, kind of preserving capital. So this is the typical way that most people approach their life, and I find that myself as well, because by the time here now recently, as you have kind of kids, you just have less time, as you get married or engaged, that kind of thing, and just life takes a toll, and you just don't have as much energy personally. That drive starts to kind of, I wouldn't say fade, but you have other priorities. It's not about money anymore. It might be more about your kids or your other loved one and the family that you build. So there's more to life than money, as I always say. So as we look at kind of these things, I would definitely look to keeping it simple, rather than trying to overdo things. So when we look at keeping it simple, this is kind of the next segment that we're getting into. So let's go ahead and check it out. Let me see here. What do I have? Keep it simple. And here we go on the schedule. So keeping it simple, I think ETFs are the simplest approach to investing. And for some people, I would say just pick 2 to 3 ETFs and go ahead and invest in them. Especially if you got kind of day job. If you're looking for just pure investment, 2 to 3 ETFs, and then you're good. So let's take a look at this and check out which ETFs. So if you go with a SPY, here is the SPY. This is kind of a basket. How do you kind of evaluate these things? Well, when you look at evaluation of ETFs, you could just go ahead and search for top dividend ETFs, and there'll be different sites that'll give you a risk kind of VYM. Here's the Vanguard high dividend ETF. So what you can do is here's your database, ETF database, 239 of them. Which one do you pick? And again, remember, the higher the dividend, usually the less appreciation it's had, and so on and so forth. So I would look more, if you're looking at the ETFs, look for some that are very popular, like average volume. This is interesting. Vanguard Total Stock Market ETF, Total World Stock. VYM I know is very popular. Here is VYM, VIG, Vanguard Dividend Appreciation ETF. This is Dividend Yield ETF. So they kind of have their own different baskets. So if I was to look this up, so you could go ahead and look up like here's the ticker symbol, VYM, and VYM Holdings. So you could go ahead, VYM Holdings, and it'll give you a breakdown. So this is kind of what it'll do is Vanguard ETFs, VYM, and you can see, hey, what's in it. And here is kind of based on sector diversification. So you can see basic materials, consumer goods, consumer services. So there's basically a portfolio allocation of what you get. So it's a pretty big list. And here's the 10 largest holdings. I mean, I think you could probably get a full list report, but usually the top 10 is going to move the market. So Johnson & Johnson, you've got, and that represents, about 30% of your total assets. Johnson & Johnson, JP Morgan, Procter & Gamble, Intel, Verizon, AT&T, Merck, Pfizer, and Coca-Cola. So these are kind of the stocks that are in there. If you want to go ahead and look at, let's say, another one, let's just go to VIG to see the difference. And let's just go to VIG Holdings, Vanguard Dividend Appreciation. And here, this one, as you look, okay, you can see the chart, quarter, and so on. And this one's going to be a little bit probably different. So let me see if I could go ahead and move it over. So comparing it, one, you've got 3.3 basic materials, the other is 3.4. One is consumer goods, 11.5, the other one's 15. Consumer services You've got 20 on this side. So this one's a little heavier on consumer services. And you can see here financials, 15% on the right versus 10% there on the left. So you're kind of looking, okay, well, what do I looking at? Healthcare, you can see this one's 16, the other one's 12. So if you want, especially now in today's world, if you want healthcare more, well, you probably go with something like VYM. If you're looking for something else, you're looking here. This one's got more heavier: Microsoft, Walmart, Procter & Gamble. This one over here on the top 10 holdings, you got Johnson & Johnson. Let me move this over here. Let's see if I could go ahead like this. You can see the top 10 holdings are a little bit different. So Johnson & Johnson versus Microsoft. It's not to say that they don't have the same type in some areas, but here's our Johnson & Johnson. Let's see, what else do we have? Walmart, Procter & Gamble, Visa. So here, Procter & Gamble, and here's Procter & Gamble. So you can see that some do overlap, but it's just the priority and weight of things are a little bit different. So what I would say is that for the majority of people, you're looking at things like this and you're checking out, hey, does the chart make sense for you, or do the holdings make sense for you? And then you don't have to stock pick. You don't have to worry about that. If you want to get into that, fantastic and great. I work with people that, we do a lot more swing trading as well, that are a little bit more active on that. You can check out our members section on the Traders Fly site. There's the swing charts that we work on. Right now we're doing a lot of option trading and live sessions with options. But you can get into it and be a little more active and proactive with it. But for the majority of people, if you just want to kind of set it and forget it, well, you check this out. Hey, look at this chart and see, does it make sense? Does it appreciate for you kind of in that way that makes sense for you? VIG or VYM. Let's take a look at this one. And if it does, then what you could do is say, hey, that one looks good or that one looks better. And then you could go ahead and buy some shares in one or the other. Now, I'm not recommending one or the other on these, but what I'm saying is that you could go ahead and do your due diligence and search for dividend ETFs that make sense. You could say, hey, there's some dividend ETFs there's some that focus on, let's say, recession type ETFs, like, that they might have more holdings like in smoking or canned soup, that if there's a recession, people usually don't give up smoking, or they go ahead and buy canned foods. So you can see there's all kinds of different things. You could get Fidelity high dividend ETFs, iShares emerging markets dividend ETFs, Wisdom Tree international small caps. So if you're looking at like small caps, there's so many ETFs out there. For most people, just stick to kind of the big ones, the dividend ETFs. They have Vanguard ProShares. You could do the SPY. You could do all kinds of different things. And just kind of do a little bit of your due diligence and pick one that has average volume that's pretty good. Mix it up with kind of an index or stock, and you should be good to go. As an idea, okay, an ETF, we've got a question here. ETF versus index. Okay, so if we're looking at ETFs, okay, ETFs, difference between ETFs and indexes. ETFs are basically diversified holdings that you can actually buy. An index, you can't buy an index. An index is just tracking the stock. So like if I go ahead and look at SPX right here, I can't buy it. Here's an index. Like take a look at this. If I go to this index, I can't buy it. It just tells you a certain price. If I go to an ETF, which is the SPY, and look at this price, right? 2836.74. So it's going to be 283 point something, 282.97. But I can buy an index, buy an ETF. An index is just an average of, hey, the total kind of value. Think of it like the big brother. So you can't buy an index. Same thing with like diamonds. Here's the diamonds. 237, you can go ahead and buy it, but the Dow Jones, I forget if it's DG, I don't really look at the Dow Jones anymore because every trading platform does it a little different. DGA, DGI, I don't remember. But Russell, let's do Russell here. Russell buy, you can't buy it. That's an index. See, it's an index right there. Tells you it's an index. But IWM, this is the Russell ETF, I can actually buy it. So anyways, point being is you can't buy an index, but you can buy an ETF. So yeah, I hope that helps out. Okay. Okay, here's another question. Let's go ahead and answer this question real quick. Okay, next question we've got. All right, what's the best stock platform for absolute beginners? Okay, depends on the type of trading you're doing. If you're going, спасибо, пожалуйста. If you're doing basically basic investing, it really doesn't matter. There's no real best platform. Every platform has pros and cons. Some good platforms, they cost a little more, but that's not always the case. So if you're doing just basic investing, any platform will do. You can go with Fidelity. If you've got things already in Fidelity, fine. If you've got things in TD Waterhouse or TD Ameritrade, you can do that, or TD Bank. Then you can do kind of the Thinkorswim platform here. You can do things with Webull. You can do things with Robinhood. There's no real best platform. If you're just doing like long-term investing, I would say if you're doing long-term investing, it's nice to have somebody you can call up on the phone and say, hey, how do I withdraw my money? How do I go ahead and get my tax receipt? That's what I find with the people that do Robinhood, and then we do coaching sessions. By the way, if you're interested in coaching sessions, I do work with people one-on-one, and you can go ahead and check that out. Go to our Traders Fly site and go to kind of coaching over here. So anyways, if you look at those things, there's no real best platform. It's just more of, if you're just getting started, go ahead and get a broker you can actually call. Because when you need your tax documents and you can't find them, and you're trying to live chat or email with like Robinhood or one of the online brokers, it's going to be a real pain. And that's what I find is the big difference. Is sometimes it's worth that extra $5-10 here and there to have like a bigger firm, because you're dealing with a lot of money usually when you're trading and investing. It's not like you're dealing with like a $200 transaction. You're buying thousands of dollars worth of stocks. So if you're dealing with thousands of dollars, I don't understand why people get too cheap. I mean, I do understand, but they really try and nickel and dime themselves on, hey, I'm going to put in $2,000, but I'm going to try to save 55 cents. It's like trying to drive your car, 25 miles to get gas 2 cents cheaper per gallon. It doesn't make sense, right? So understand the services you might need. So if you need to go ahead and call them, sometimes it's worth that, especially if you're a beginner. I like TD Ameritrade. I think they do good stuff. I think Tastyworks also a very good platform. I think any of the other big firms like Schwab, it's good. They're fine for general investing. But if you're trying to go ahead and just look at the fees, then that can become a little bit of a problem. We'll cover this a little bit more as we get into kind of brokers. I think we're getting a little ahead of ourselves. So, keep it simple. Look at these ETFs, do some research, and see what makes sense. If I was to suggest something to someone, let's say my brother or my uncle, I would go ahead and say, hey, go ahead and get yourself maybe, and you could allocate it however you want. Go ahead and get yourself maybe the SPY, which is the overall market, or you could go ahead and do the IWM if you want. Go ahead and get another ETF that's kind of like a basket of dividend ETFs, maybe like that VYM or VIG we talked about, or something else that's kind of like a safe basket. So you could split that. Then what you could do is get maybe something that counteracts that, like a TLT or a GLD, which is basically treasuries or gold, something that works a little bit against what you normally get a lot of money for. So this is usually slower investing. It doesn't make you as much money, but what happens is it counteracts maybe if you get a downside move in the market, these things may skyrocket a little bit higher. So get something that's a little bit different. It could be like silver, I think that's SLV, or something else. I'm not recommending it, but something to counteract. And this might be maybe like 10% of your money, not a lot, right? It's just a little bit to cushion you. Then what you might want to do is, if you want to get a stock or two, you could get like 1 or 2 stocks But again, these might be only like 10% of your total holdings. I would rather put a lot more money, more in kind of these two areas. So this might be, I could be like 70% of your money, and the rest could be kind of in cash if you want. And that could be as simple as you make it, because now you got 70, 80, 90% invested. And of course, if the market's selling off in a big way, you could go ahead and do a little bit more in these indexes, or not indexes, in the ETFs. Or if you don't really care or deal with stocks, then don't worry about it. Then just kind of do something more like those. And if you're not worried about something counteracting on you, then again, just get maybe 2 to 3 ETFs and you're good. That's it. Keep it really simple. And that's my kind of keep it simple approach. If you want a real hands-off approach, this kind of leads me to our number 8 over here in our schedule, is target date retirement funds. So target date retirement funds are basically things that adjust with time. And if you look at something like, let's say we talked about year 20, and then you go ahead and, you might want higher risk at the beginning, and then you go ahead and as you get to 30, you get a little less risk. Then you get to 40, even less risk. When you get to 50, even less risk. So what these target date retirement funds do is slowly with time, they shift and morph and mutate your risk. So now you basically have less and less risk as you age. And a lot of companies do them. And if we go ahead and take a look at some of those, you could just search for them. I know Vanguard does them. Not that I'm promoting Vanguard. I don't get anything from it. It's just easier to look them up. Target date retirement funds. And you can see Capital Group, Invesco, there's a Schwab funds, they have all kinds of investment products. So you can go ahead and basically go into this, and let's say, okay, years to retirement, it tells you birth year. So if you were born between 1998 and 2002, you got about 45 years. If you're born, let's say 1988 to 1992, you got about 35 years till retirement. If you're born 1978 to 1982, you got about 25 years to retirement date. So it tells you here the target retirement date of 2045, 2050, 2055, 2060. So what you do is, let's say you go ahead and say, hey, well, here, my target date retirement fund is 2060. So what it does is it tells you, hey, here's your fund. Here's kind of the thing. You could go through Vanguard to do it. And it tells you your risk potential, more risk, more reward. And it tells you how the funds performed and kind of some allocation. So it kind of, how it ranks and so on. So it's the same concept, but what it does is it switches kind of the holdings, right? So here's your asset allocation. You still got 89.57 stocks. You got some in bonds and some short-term in reserves. So this is kind of this fund, 2060 target date. Let's look at another one. Let's say, what do we got? 2040 here. And let's see, here you've got a little more in bonds. You got 17.01 in bonds. So it's a lot, more in the bond sector, whereas this one's 9% in bonds. So it's definitely, the risk starts changing and shifting based on your retirement date or your target date. So this is kind of a good set it and forget it type of thing, and you can get 1 or 2 of these. And I'm not saying that you have to go ahead and choose your exact retirement date. It's just, if you're choosing one that's closer in, what that's going to do is it's going to make it a little more safe. If you're choosing one further out, you're going to be a little more risky. So it's not saying, hey, you got to choose one when you're going to retire. It's just saying that you might want to go ahead and choose one that, makes sense to mix it up, right? So you might do like one of these, as we talked about before, like a target retirement date, if you're looking to really mix things up. So I've got now my SPY or IWM or some kind of ETF. Then I go ahead and include, these target date retirement fund, and maybe I do a stock or 2, and then I may have something to counteract anything. But again, my main holdings would probably be, either the target date or the SPY. And then these things are kind of light. So this would be light, and these would be kind of my main holdings. So that's kind of the way I would look at it. And for that, you don't really need a kind of a money manager or a wealth manager or a mutual fund manager, because they take up a lot of fees. And that's kind of going to be my next part that we're going to look into. Is we're going to look into step 9 here in our schedule. We're going to get into some brokers and really fund managers, money managers, and that kind of thing. And I think a lot of people, what they do is they instead of going in and selecting these things and getting themselves an online broker, discount broker that we've talked about, they go ahead and they give their money to money managers. And I will tell you, I've had coaching students, not only just for swing trading, active trading, but I've had people just call me up because it was an easy way to find someone to talk to about investments who was a third party, non-biased, and I didn't have their money. And I would hear stories of things like, hey, I gave $2.5 million of our estate. Our grandparents died. They gave us $2.5 million, but we're seeing that they told us to put money into these things, and that money is just constantly every month losing $35,000. Why is it doing that if the market keeps heading higher? So it's interesting that these situations do come up, that people lose a lot of money from money managers. And as I mentioned before, that's not their priority, is not necessarily to go ahead and give you the best return on investment. They keep you happy. Their first line is to go ahead and make sure that, hey, they're worried about themselves first, then their job, then maybe you, then maybe your money. That's the typical hierarchy. So when you look at, let's just talk a little bit about these money managers here. And a couple of things you really got to understand is that if you have people that are holding your money or managing your money, let's just talk about money managers. A lot of this, what you're really paying for initially is education. So they want to educate you on how investments work, kind of what we're doing here in this training video. But they're really looking at, hey, how do these investments work? How do they function? How do you make money? What kind of return can you expect? So they're just guiding you and holding your hand. But for a majority of people, it becomes very expensive. And you might say, hey, well, they typically are supposed to beat the market. Well, number one, they rarely beat the market. And even if they do, well, I'm going to talk to you about this it really doesn't matter. Even if they do beat the market, you still end up making less. So in general, they are typically a coach, as we talked about. It's kind of what they do is they educate you, and they're looking for maybe advising you on what you should do. And they really have to keep kind of things invested, right? They can't just sit out, because if they sit out, you're going to be wondering, well, what in the world are they doing? Well, where's my money? How am I'm not even making any money. Well, what are you doing then? So people get pissed and they get annoyed with it. So they have to be invested. So they have to be in some kind of stock or some kind of investment. And they do make a ton of fees when they push you into products, just in the same way we talked about Robinhood, that they go to their buddies and they make extra fees from you getting other mutual funds or different things, commissions and cuts and that kind of thing, kickbacks from the people that are pushing it, those things. So the thing is that even if they do, let's say the market, as we talked about on average, here's the stock market of an ETF on SPY, makes 8%. Let's just say, for conversation's sake, even if these people do beat the market on average for you, let's say they make you 14% or 18%. Well, remember that they make money not based on your returns, but they make money based on the number or dollar invested. So the dollar invested that you have is, they take a cut or a percentage of that. So even if you make 18%, well, that amount that you have invested is a huge cut. So you might actually, even if they made you 18%, they might actually go ahead and make you only, by the time all the, because the dollar invested, they might take half of that. And now you actually might only be at 9%. So is it really worth it with all the headaches and that kind of stuff, and fees. And sometimes it might be even less than that. So in either case, they got to really beat the market. And if they are only matching the market at 8%, if they match at 8%, the market, then, well, you might actually only be at 4%. Okay, so you might actually be losing on the market. So understand that this is a very important point to understand, that, hey, you're probably not making as much as you could on your own, because number one, you've got the fees. They have to be invested. They can't sit out. The dollar or percentage invested is where they make their money. And even if they do beat the market, you might be at the market level. And if they match the market, you might be below the market level just because of all the fees, the percentage invested, and so on. So when you look at these money managers, you can do just as well, if not better, just doing it on your own, because you cut out the fees for the buddies and you cut out this fee for the dollar invested. And all of a sudden that ramps your earnings up if you just kind of do a buy and hold and sit tight approach, and you're just looking for average kind of market returns. Because if you're looking for average market returns, well, you just buy the market and then you're holding it on for life in a way, because now you're going to get the average, right? So based on what we just talked about with the portfolio allocation. So when we look at these things, you can do it yourself, DIY, right? That's what we're talking about right here, is to do it on your own. So what do you need to make that happen? Well, you need a couple of quick things. You need, number one, you need some capital, you need some money, and you need a broker, which is where you place the trades or something that it goes through. And you basically just need to be able to know how to do that. And after that, really just an internet connection, you're good to go, and really a little bit of patience. So the whole thing behind it is that once you have this cash, actually let's draw it back on the board. We talked about this earlier in the session, is that when you've got your cash, this is just this linear process. You've got your cash, you put it in your broker, okay? From your broker, you pick your investments, and you just do the trade. And that's it. And then you wait. That's it. There's nothing to it. Eventually, later, what you do is you sell or get out. Now, day traders or active traders, they do this way quicker. They already have a broker. So all they do is from here, they just loop right back and do this process tons and tons of time over and over again. So in our case, all we need to do is, now a lot of people always wonder which broker and so on. There's a ton of brokers out there. We've got a list here: E-Trade, Scottrade, TradeStation, Trade King. There's so many, and they constantly get updated and bought out. List of stock online brokers. And what you're looking for here is, TD, Fidelity, Charles Schwab, E-Trade, Interactive Brokers, Merrill Edge, TradeStation. So let's just look at Fidelity. I haven't really looked at Fidelity in a while. Fidelity stock broker. So I'm curious to see here what they're all about. So what typically people do is, I look for customer service and support phone number for most beginning people. Okay, got a question. Where's the phone number? Okay, here's the phone number. Okay, easy enough, perfect. Probably have a good amount of representatives. Give them a call real quick and see if they're good to go, if they pick up the phone. So that's kind of one thing that you might want to do. The second thing is, okay, you're looking at Fidelity. You might want to go ahead and, this compare online brokers thing isn't always perfect. They usually match up things on trades, because they always put themselves in their favor. So just be careful of that. So when we look at these kinds of things, it's not really helpful. I look at more, let's see, Fidelity account, 0 commissions, who cares, right? Because again, you're going to put on a couple trades, even cost you 10, 20 bucks. It's not a big deal. Customer service may be a big thing. If you're doing more active things, people will look at the fees, because, I don't have to pay. I don't have to pay. 0 fees on US stocks, ETFs, and option trades. View commissions details. See, okay, so stocks, 0. Look at that. Any number of shares, because they make a lot of money on other things. Options, all online option trades, 0. Buy to close, 65 cents or less, 0. So 65 cents. So ETFs and so on. If you're looking at other things, let's see, Schwab here. So you can look at trading platform. So you can see, hey, what's the trading platform look like? Unfortunately, a lot of these demos you can't really do until you go ahead and fund your account and sign up. But the sign up process is not too bad. So if you go ahead and let's see, maybe you could download that one. If you go ahead and let's see, go ahead and try and sign up, accounts and trade. Let's see, it's going to be open an account, register. Here it is, open an account. And what you typically do is when you're looking to open up an account, there's different types of trading accounts you could do, like a rollover IRA, traditional IRA, Roth IRA. You can do standard account. You could do accounts for education, like if you have kids and you could trade in that account, like they go to college. So those are the most popular ones, but really there's so many. There's estate planning, annuities, life insurance accounts. There's so many types of accounts. So look for retirement. Here's all kinds of retirements for kids retirement, inherited IRA, so SEP IRA. So this is the whole point behind these account types is tax planning. So talk to your accountant about it, depending on what you want. Most people go with, if you're trying to do active trading, you're just doing kind of like a brokerage standard individual account. It'd be a margin account. But there's so many other types of account types, as you can see. Custodial, estate, a trust account. So you could have a trust, life insurance kind of account. I guess there's just so many types. So anyway, point being is you go ahead, you fill out a lot of forms for it, you go through the process and you download the platform, and then you'll get something like this. There is a lot of brokers. We talked a little bit about like Tastyworks. So this one focuses more a little bit on option trading. So you can see options is the first thing, options and ETFs, options. So they talk about their pricing and fees. And their broker platform is very good because the guy that designed it also designed Thinkorswim. Tom Sosnoff, he was a broker at the CBOE, did options for like 20 years, and then he went in and developed platforms, and then he sold that for like multi-millions of dollars, and then now he's developing this one, which is an even different platform, but again, the same concept applies. So you can see a lot of cool stuff with options with this one, desktop, browser, mobile, they got it all. Thinkorswim is a good platform for options as well. A lot of the other brokers, I just don't care for options trading, but they're fine for basic investing. Schwab, let's see, Schwab. And when you're looking at those kinds of things, Schwab investment broker, it really doesn't matter too much. If you're just buying stocks or a couple of ETFs, it doesn't really matter too much. So let's see here, Schwab brokerage account, same thing. You see, boom, a lot of them are like the fees are not a big deal. So I would rather go with a larger broker with a phone number because of just, you can say individual, joint, and there's probably many other types of accounts there. If you go to like joint accounts, let's see, joint, tenant with rights of survivorship, tenants in common, and so on. If you go with individual, there you go. A social security number, you just set up an individual thing. Okay, I got another question here. Let's see here, what do we have? Let's see, sorry, it's not related. What is it? Sorry, it's not related to this section. Could you explain what going short and long means? What's the right time to do that? So when we're looking at going, I'll talk about it here real quick for you since, it's not in this section. When we're looking at going short, we talked about this risk profile picture here before, right? So do you remember this section? Were you here for that? If we look at McDonald's and we go and we buy some shares, okay, typically when we buy 100 shares right here, we've got this going long. So going long just means, hey, I'm long, I own the shares. Because what I could say is I sold, if I was talking to a buddy, I sold 50 shares. Well, if I go ahead and let's say I sell 50, I bought 100, but then I sold 50. So if I was in a conversation, I said I sold 50 shares, they're gonna think, oh, well, he sold 50, he doesn't like the stock, but I'm still long 50 shares. So it just means my total position. My total position is long 50 shares, regardless of the total transaction. So long just means I'm looking for an upward movement. Short means I'm looking for a downward movement. So when you're short, you make money by selling the stock first. How does that work? Well, just like on eBay, you sell a camera and then you deliver it. In theory, you're always short first. So you sell it, then you deliver. And what you do is you could go ahead and sell a camera even if you don't have it. And then if you know your buddy's got it for like $20, but you sold it for 50, well, you know, and then you buy it for 20, well, that's what happens. Or in this case, let's say you sold it for 184, and then you look for the price to go down, right? Because you buy it back at lower price. So you sold a camera for 184, but you know your buddy's got it. He'll sell it to you for 170. Well, the difference between that, it would be here $2,165. Why? Because I got 150 shares. If it was just one camera, right? And we look at just a single camera. Well, the price difference here between me selling it on eBay for 184 and buying it from my buddy at 170, I make $14. And the thing is, with stocks, we're dealing with multiple shares. So that's all it means. It's going short and long. All right, so going back here, brokerage account, as we look to these kinds of things, you just need a couple social security, employee address. If you're international, you do need a couple of tax forms. So that way they don't do withholding tax and stuff like that with you. So you do have to fill out a few things there. But beyond that, once you're set up and good to go, you basically go ahead and you get your broker account, just like opening up a bank account in any country. You open up your bank account. In this case, you open up a brokerage account. You put some money in it and you fund it. And then you go into this panel, which looks a little more confusing and intimidating, but think of it like logging into your bank. Some banks, it's a lot easier to do withdrawals and transfers. Other banks, it's more difficult. So in this case, you just got a lot of data, information, but really you just need to do one or two things. So in our case, what we need to do is we need to buy and sell stocks. So that would be the next thing, and that'd be placing a trade. So let's go into this next section here and go in and talk about putting on a trade or investment. And we're getting kind of where are we now? Almost 2.5 hours going. So long time. And thank you all for sticking with me so long. It's been a while since I did one of these basic kind of videos. So truly appreciate it. So cheers to you guys for sticking around. And I don't know where you are in the world, but it is kind of late over here. So anyway, so to place a trade, it's not too tough. It's going to become second nature. There's hot keys and short keys to make it quicker. So let's kind of chat a little bit about that and get into it. So to place a trade, you put in your ticker symbol. Let's say I'm interested in Nike. I like Nike. I like the chart. I might go ahead and say, hey, okay, here it is. Here's Nike. Here's my chart. I want to get in it. Here's the daily. Here's maybe the weekly. In either case, you evaluate your stock based on what we talked about. And then you say, okay, I want to get Nike. I'm ready to do it. I go ahead, right click, buy. Some of them, what you can do is you can just kind of click them in different areas. There's different types of ways to do it. In this panel, you just got to learn your panel. You right click, you buy it, and then you have your share numbers. Now mine is zoomed in just to make things a little bit easier to see for everybody. I always zoom in. Just yeah, you're welcome, righty. Yeah, thank you for teaching us. Yeah, you're welcome. And then I right click. I analyze the trade, but really you don't have to go that detailed. You can just go ahead and right click, confirm and send. It'll tell you, like right here, it tells you how much cash it takes up, result of your buying power and remaining buying power of options and so on. So it'll tell you, I mean, this is a paper trading platform simulation. So I'll put in like fake trades in here for people to see how it really works. Right now the market's closed, so it won't really work. But it tells you, here's your description. It gives you an order thing. You could actually not even have this. You could just go right to it. You can, where the minute you push that other button, auto send with shift click, right? So you could turn that on and make this way faster where you boom, 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 if you need to trade quicker. But here, this is kind of a ticket. You're going to buy 500 shares of Nike at this price to open up the position. It's going to cost you X amount plus your commissions. And then your buying power effect will be whatever, down 22,000 because I don't know if that account it's a simulated account thing. It only has like 150 or $200,000 in it. So result buying power of stock, what's going to be left, result buying power for options, what's going to be left. And then what you can do is you can send it in. And that's basically it. And that's the way you would work this trade. I don't know, let's see if I can maybe put one in right here, right click, buy. Let's see if we, I don't know. Again, this is simulation. So confirm and send. Let's see if it'll pop it in on the, so it'll put it into like a working order. Obviously it's not gonna fill it right now, but it'll do the working order. And then once it's filled, it'll go into a filled order. If you cancel it, I could go ahead, cancel order. It'll go in the canceled order section. So that's really just the basics of putting an order in. If you're shorting a stock, you can sell first, right click and sell first. I don't know, again, if they let me do this in this platform right now. I could go ahead, right click, confirm and send, and then it's to open the position. So you can see, no, I don't think that one will work just because this platform, the way it's set up, it's a simulated kind of platform. But in either case, it works the same way when you're shorting or when you're buying a stock. It's just that later on when you close the trade, you would buy it back instead of selling it. In our case, if we went ahead and we right click and buy, and here we go, confirm and send, then once this is bought, okay, then what we would do is we would right click and sell. So we could just sell, right click and sell, and then it would kind of clear the deck. So in either case, that's the way that process kind of works. Okay, let's check it out. We got a quick little question here. If you short a stock and it goes up, when is the money due? End of the day? No, it's whenever you get a margin call, really. It could be months. If you short a stock, yeah, it could be months, because if it's going your way, the broker's not worried about it. Because what happens is when you're shorting a stock, you're borrowing it from the broker, right? And if it keeps going down, they're not worried about it because you're profitable. They know you have the money in a way because you're profitable. It's fine because they loaned it out to somebody else or from somebody else in the brokerage, right? Because they have like millions of customers. So don't worry about the broker in this case. So what you got to worry about is your position. So if it does start heading lower, it's in your favor. They're probably not going to margin you out on it. They're not going to force you to sell it because it's still going in your favor. You're still profitable. The issue is once it starts going against you, and let's say you're down like $700. Well, if you got a $1,000 account, that's a lot. That's a large percentage. And they might actually margin you out and say, hey, you got to close that trade in. But it might not be today. It might be like the next day. So within 24 hours usually. But if it took like 3 or 4 days for that to happen, then you'd be like on the 4th or 5th day. Again, it just depends on broker to broker. They're all different. Stock to stock, that's all different. It just really depends. Again, if you're trading a larger account, it may not be all the way till a lot later. Or it could just be that the broker needs it. And if it's going against you, that they say, hey, I need this. So they'll go ahead and call you up, even if it didn't go down a lot. So, or meaning it didn't go against you a lot. So anyway, point being is that if it's going in your favor, it's not a big deal. If it's going against you, that's kind of more of a bigger issue. So anyway, that's what I would look at for margin calls. It's not necessarily at the end of the day. You don't just day trade by shorting, or you don't short due to kind of day trading. All right, so that's basically how you would go ahead and put on a trade or an investment. That's just the basics of it. Every platform is different. You could go ahead and look up order stocks, and let me see if I go images. So you could see this one. Here's kind of an order on Ameritrade maybe, or a different platform. You could just go ahead, you sell 10, Apple, day, and so on. There's different order types. There's even things like here at the bottom. Here's kind of another order ticker symbol from Ameritrade. Some of them kind of look like this. You put the ticker, the action. They're really simple. So they almost look like really old websites. And some kind of look like this. So everyone's a little different, but they're all kind of the same. in a way. So what you want to do is when you're putting that order in, there's a couple of other things that go with it. So if I go ahead and cancel this order so we don't get filled. If I go ahead and try and buy this order, you can have a couple of choices. Limit is the price you set. Market is just give it to me. So be very careful here. And when you say, hey, just give it to me, just like ordering fish at a restaurant, if you just say, hey, give it to me while you show up and it's like a $75 bill, you're like, ooh, I thought it was going to be a $15 fish sandwich. Well, it's a $75 bill. Well, that's what you got to pay then. So anyways, let's check out here another quick question. What do we got? Deep Sun, I'm beginning about stock market matter. Even though I want to open a brokerage account, do you recommend that? Yeah, I mean, if you're just getting started, there's nothing wrong with opening a brokerage account. You have no risk to opening a brokerage account. If you're just beginning and you're just getting started, you can still open up a brokerage account, just saves you time later on. Just, I wouldn't put the trades on until you get a little bit more underneath your belt and learn a little bit more. So, but opening up a brokerage account's fine. It's free. There's nothing, you don't have to pay for it unless certain brokers, I think like Interactive Brokers, they have inactivity fees. So if you're not active, just check for that. But other than that, yeah, most of the other bigger brokers, they're fine. They don't have any inactivity fees, meaning if you're not trading, they take out like $10, $20 a month. But most of them don't have that. So other than that, yeah, it's fine. Fine to get a brokerage account. Just be careful trading or investing until you get some knowledge. So anyway, okay. So that's how you put on a trade. As far as managing the investment, you know, this is going to be our next thing. So let's go ahead. We've got like 1 or 2 sections left, and we'll see here how well I can go ahead and go through this. Okay, we're on managing the investment. Excuse me, managing the investment. And here, I'm just going to keep it simple. Okay, when you manage an investment, for some people, they're just buy and hold. And that's totally okay. There's nothing wrong with that. If you just go ahead and buy, you hold, keep it simple, and then you're saving a ton of money from the money managers, no problem. But if you want to actually manage it a little bit, what I would recommend is kind of have a set plan or goal or what you're doing with your money. Whether number 1, you're constantly adding your pool of money, or number 2, taking things off when there's risk. So what I would recommend is when we start looking at things, let's just kind of go here to the paper. And as we look to things, if the market or the stock or your investment, let's say, again, you don't want to be in it too much, but you kind of have a few ways to manage. And it just depends how active you want to be. Similar to number 1, very passive, which is, you know, passive income. So you want to be very passive, so you just buy, hold, and you're done. That's kind of a good first step for most people. The second thing is kind of a little bit more active, so lightly active. So in this case is stocks explode. Think of it like stocks making regular news, right? So it's like regular news. Not just like the stock market news, but stock making regular news, meaning like, hey, the market's down, let's say 20%, or the market's up like 22% for the year. Well, this is a good time to sell, right? Contrarian, and this is a good time to kind of buy. Like right now, coronavirus type stuff, it's been a good time to buy, and now you see in the last 40 years, we've had a really good run up kind of in the last month, right? So over the last 40 years, it's been like one of the best run-ups because we had a major sell-off, big time panic. So usually when the market's down, it's a good time to buy, right? Everybody's in a panic. When there's fear and blood on the road, you buy. That's what the Warren Buffett kind of concept is. And when it's up really, really high, a lot of people reduce your risk. So if you have, let's say, 1,000 shares of anything or total, well, if the market's like, let's say, just exploding to the moon, well, you might want to take like half off. You don't have to take everything off, but you take half off. And then when you get, and then when the market like tanks and now it's down, well, you buy these 500 shares back. Okay. And you might even be able to get like 600 or 700 shares, depending on how far it pulls back. And you can see this concept in stocks like a Tesla here. So let's just go here in Tesla. So here we've had a run up, like a major escalation, right? So if you were invested here at maybe about $200-300 a share, the stock ran up to about 900. Well, look at this movement. You went from 7 to like 900 in a few days. Well, that's a good time to take some money off, because you see what happened is we were up at 900. You go down to 300 or whatever, let's say, even if it got down to 500, you start buying more back, right? Because you invested at 300. You start buying some more again around 500, and you get that money back, and you're able to invest in that stock again. And now again, it kind of ran up. So again, you're taking a little bit more off. So you have your sell points here and your sell point here. Even if you don't time it perfectly, it doesn't matter. Even if you got it, look at that bar. Remember we talked about breath? In this case, boom. Like, look at that breath. I mean, it's so fast. That stock ran up. So that's quick. So you take some profits. And then it pulls back. It's like, choking, I can't breathe. That's the time you buy. And market always works in counter trend actions, and this is why they say being a contrarian is a good thing. And then eventually it snaps back, right? Because we talked about inflation. Because inflation, it continues to run things up. So, anyways, anything like this, you could do it also in a short term. This is what really day traders do. But if you do it in a short term, like we look at Disney here, right? Disney's pulled back here, and then you could see a little bit of pop, but ultimately, right here, this is what you're looking at. Disney was flatlined. It bounced a lot right here. This was the time to sell, right? So even though you might think, hey, well, I was in the stock for a while, didn't do anything, and now it popped. Well, yeah, a lot of people say, hey, it could be a good entry point too, right? If you're new, this is another entry point. But if you were already in it, you might sell, if you had like, let's say 500 shares, you don't have to sell everything, but you sell 100. Right? Take a half, a fifth, a quarter, something off, and then eventually now it's back down. Well, I buy that 100 back. Actually, I could probably get 120 or so. So I buy it back, and now I'm at a little bit more. I'm at probably 520 shares instead of the 500 that I had earlier. Way back here, I had 500. Here I had kind of 400 now. And then now over here, I got 520. So boom, more dividends, more appreciation again, and you just let it continue to ride. And that's what you do. And you can do it on a shorter term or longer term, it just depends. And you can use the moving averages that we talked about to make that a point as well, to, hey, getting into some things and out of some things, just depending on moving averages, how far things are stretched. If they're really stretched from the moving average or stretched on this end. That can really kind of help you out. If you look at more of the weeklies as well, stretched way up there, stretched way down here, stretched up here, stretched up here. So you can see we get into those stretched levels and they bounce kind of the other way. It's like a rubber band effect. So anyways, that would be the just a simple approach, is to just kind of do something like that, where you're taking a little bit of money off, which means you're reducing your delta, which means you're reducing your risk, and then you put that money back on, which means you've increased your risk. And market's down in a big way, good time to buy, right? Market's high, good time to sell, take some profits. And there's a lot of issues when it comes to the market pulling back. People are always worried about risk. This is going to be kind of our next section. We're kind of getting to the end, because these topics, again, you could talk multiple hours about any one of these depending on people's certain situations. So let me go ahead and cover this last little bit, protecting investments with options, because I deal a lot with options. Actually, I would say that's probably like 95% of the trading and education business that I'm in is the options business. So if you haven't seen that area, options can be very powerful, very flexible. And I think it's probably the better way to trade for most people, if you can learn it. If you're interested in getting that education, definitely check out our website there at tradersfly.com, and go to the Getting Started Options Trading 101. You can see some of the education, some of the freebies and options, the books, the courses, and even the coaching that I deal with in options, and the memberships. So many different things. And the website where I have all the courses when it comes to options, you can go to the Rise, number 2, Learn. You can see there's so many option things that I'm working on in the works. It's just because they're very complex in the sense, but because they're complex, it gives you the education edge, meaning you get the flexibility of things. So anyways, let's see here. Got another little question here. Let's see. What's the difference between a DMAT account and a brokerage account? And if I open a broker, can I invest on the stock market? I don't know what you mean by DMAT account and brokerage account. And if I open only a broker account, can I invest in the stock market? Yeah, brokerage account will get you the ability to invest in the market. I don't know what you mean by DMAT account. Is that an abbreviation for something? Maybe. Okay, so let's look at protecting kind of your stock with some basic options. So typically when you look at, let's just chat about Nike here while we have it. An option is a contract and it has a certain amount of time. Think of it like a coupon. Coupon, you get a free burger, buy one, get one free, but you have a certain amount of time. You got to use it in the next month. So there's certain conditions. You've got calls and you've got puts. In our conversation, we're going to take a look at puts. And in the put section, when we go ahead and right click and buy stock, and we have just overall the stock position here. So here's our basic stock position. I got 500 shares looking to invest. So as it goes up, I make money. As it goes down, I lose money. So here, as I go ahead and look to protect this, the problem with this is, just like you have insurance on people, insurance on car, when you have a $10,000, $20,000, $50,000 car, you have insurance on it, right? And the same thing you can do with stocks. Now, a lot of people don't do it, but you can do it. So wouldn't it be wise to invest something if you've got, let's say in this case, 40, 50,000, or let's say you're dealing with 1,000 shares in Nike, you're looking at what, 88,000? Wouldn't it be wise to insure it when things go against you? So yeah, let's see. Is there a discount code for Options 101 or Swing Trade 101 or coaching? Righty asks. We can go ahead and do that. Why don't you go ahead and send a note on the live chat, actually, and anybody who attended the webinar here on any live chat, we can go ahead and create a coupon for you just based on what you want. So for those of you that attended, especially towards the end here, we can go ahead and do a coupon for you guys on any of these things. So yeah, sure. Okay, so when you're looking at this, it'd be wise to have some kind of insurance, and that's what options allow you to do. Now in our case, we're going to focus in on the put side. There is the call side, which gives you the right, meaning the choice, you don't have to do it, the right to buy a stock at a certain place, you don't have to have it. And then you have puts, it gives you the right to put or place that stock to somebody at a certain strike price for a certain amount of time. You could buy these coupons 7 days out, or 14 days, or in other words, options, 21 days till expiration, 42. The further out in time you go, the more expensive they really get if you're a buyer. Now, when you're typically a buyer, you lose money on options because they have the time value. In most situations, if you really want to know, look at the Options 101, the getting started. By the way, the Options 101, the page here, the getting started, not the course, but the getting started page is free. So check that out. And if you want the course, it's going to be kind of similar to this in a way. But when you're looking at this kind of concept, you know, most people doing singles lose money. So if we're looking to buy a put, you know, we're going to be losing money, right? Anytime you buy something, I buy a phone, I buy a car, I lost money. I've taken money from my pocket and given it to somebody else, right? To the insurance company. So in our case, we'd be buying a put, in this case, to be able to put that stock to someone. And you can see I have different levels of insurance. Well, if Nike's at 88, well, if I want to be able to put it to someone at 87, well, that's going to cost me $395. and controls 100 shares, so you have to do your stock in lots of 100. Each contract controls 100 shares, so it'd be $395. If I want to protect it at 80, well, that's a lot less for that insurance. It's $1.88, so $188 per contract, meaning 100 shares to protect. But the proper approach is to trade options more like spreads, which I showed you kind of at the beginning. Let's just show you here NVIDIA again. Did I show you NVIDIA? Maybe, let me see. Maybe it's in this account. So here's NVIDIA. So you can see it's a spread. It's kind of wider. And my actually the theta decay on this is negative. Let me see if I got the QQQ here. The theta, what you can see is positive. Every day I'm making money. So with time, as I move forward, I go ahead and make money. So you can see I make $23. So the next day, this profit and loss would be up $23. So 217 to 241. But when we look at kind of our Nike example here, if I go ahead and buy a put at, let's say 87, right click and buy a single, and I'll analyze the trade. So what that does is, just to show you, okay, I'm in the weeklies here. Let's go to June, and let's go, if we've got 100 shares and I get one put, what it does is, let's go to 85. So I'm protecting at the 85. It cost me $4.15, which means $415. So if I get rid of the stock, the put basically makes money this way. So there's two lines here. One's at expiration, and one is today. So the white line's today, the green line's at expiration. So with time, I'm actually losing $5 a day because, you know, it's insurance. Eventually you lose more and more money because the premium keeps decaying, and then you got to pay again if you want to insure things. So anyway, here, let's see, another question real quick. What account should I have for investing in stocks? Individual account, retirement account, either one is fine, whatever works for you. Okay, so looking at this, when you have a put that you're buying, you lose $4 a day in this one. But the cool thing about it is it works opposite of your stock, right? In this case, you make money as it goes down. In the stock, you make money as it goes up. So this gives you the right to put that stock to someone else. So if the stock goes down and it gets to 85, well, all of a sudden you lose the amount from the stock. Here's your $784, but that's it. You don't lose much more. And if you had, let's say, 300 shares, well, you could go ahead and buy 3 contracts. And then again, you would lose a little bit more, but let's say that stock now goes down to 65. Well, you'd lose $2,352. Or over here, it goes down to 81, you still lose $2,352. But with a single stock, if it goes to 63 here, you'd lose $7,698. So think about this. You're losing $2,000 versus $7,500 or so. So that's kind of what we're really looking at, okay? Is that the big risk is here. You're looking at kind of this, the flattening line of your risk, your flattening of your loss, and that's what you want to do with the puts. Now, granted, it's expensive. It costs you here in this case $1,245. Now that $1,245, why? $4.15 each, and I've got 3 of them, right? If you've got 3 of them, it costs you $1,245. So anyways, that's one big thing that you want to go ahead and consider, as especially you're dealing with larger investments. If you're dealing with $80,000, $100,000, insurance can pay off. Now, there's better ways to insure these things, and there's better ways to trade than just stocks. But again, this is kind of a basic video. So if you go ahead and deal with only options, you can kind of get the same risk profile pictures and that kind of thing, which is way more advanced, but it requires more study time. But what you can do is go ahead and create spreads that kind of mimic results without having this big downside risk in stock, because it's not an efficient way of using capital. But again, set it and forget it. Couch potato strategy, buying stocks, fine. And then to protect yourself, you would just get a put. Now, could you just do 2? Yeah, absolutely. You could do 2. And all that does is kind of slow you down. So now it goes on the risk profile picture, it goes down, and then it slows it down. Instead of as fast, it slows down your kind of delta effect there, meaning the amount of risk or speed that you're going to be losing. Okay, so let's go ahead and check out a quick question. Sasha, please explain in a couple of words what delta means, intrinsic and extrinsic values as well. Okay, so delta just means, we talked about this at the beginning. Delta means the rate or the speed of change in your profit or loss for every $1 move in the stock. So if the stock goes up $1, in this case, let's just move it up $1. And keep in mind, I'm starting with negative 96 because of the BidAsk spread, but it goes up $1. I've got 300 shares, which means I got 300 delta. Okay, so I'm making here $300, which is 204 because I was starting out with a loss of about 100. If it goes up another $1, let's say it goes up $2, add 300 to 204, you get 504. That's delta. So it's just the speed of that curvature. If I go less shares, get less steepness, more shares, faster steepness. Okay, and intrinsic, extrinsic value, basically it just means, is it worth anything at expiration or not? So here we can go ahead and look at option theories. And let's see if we got it here. Basic. Should have it. Where is it? I must be missing it because I looked at it. Here it is, intrinsic value. So you can see here some of these have some intrinsic value, which means they're worth something, right? So these are actually worth something. You can do something with them. Here, they're not really worth anything. And if you look at this in the same way, intrinsic, you know, they're not worth anything because they're out of the money. You can't put those things to anybody yet. Here, you can. They're worth, and this is the value of it, kind of, in a way. If you do, let's just put it next to each other, the extrinsic, here you've got kind of a different effect. So it's kind of the time value premium in a way. So anyways, intrinsic is just basically meaning, hey, is it worth anything at expiration? In it, right? In it, is it worth anything in there? And if it is, it's in the money. Extrinsic here is kind of the time value premium they associate to it. So wouldn't worry too much about that. So anyway, the thing you got to be worried about is if you're a seller of this and this gets kind of under, you know, kind of $1 or so. Let me just show you. You actually have a chance of getting kind of more assigned if you're a seller. So look at this right here, like these, you know, it's under $1, 7 days to go. So here, extrinsic value, you could get into some trouble there if you're a seller. So I hope that helps. Okay, so when we look at Nike, or back to Nike right here, and I go ahead and reset it, here with options, you can see that I could go ahead and just protect myself. And you could even add additional protection that, hey, if it really tanks, you could actually make money from it. That's kind of a basic way to look at it. But again, like I said, this is not the smart approach, because what most people do when they trade options, they go ahead and kind of buy a single put, like thinking, hey, the stock's going to go down, so I'll go ahead and buy a put. Or they think, hey, the stock will go up, so what they'll do is they'll buy a call. So they'll go ahead and say, hey, well, I got more days. Because this is what typically people teach. I buy a single call. But again, you're losing money and value every day. So they'll buy this call. But the problem with this is it has to run up so much to offset the time that you lose. So every day you're losing money right here. And now all of a sudden that stock doesn't have to just run up to, like, you know, just a little bit for you to make money. You actually go ahead and you got to go up to like 92. So just to break even. And every day that white line continues to lose money. So you can see it just losing more and more money. So your run has to be longer and longer. So most people trade options like this. It's not the right approach, but it's the easiest approach. But that's the way they trade it. I think the smarter approach for you, if you're just investing, go ahead, own shares, and periodically, if you think the market jumped up, let's say 20% in a month, then you can buy yourself like a put or two. So you could go ahead and buy a few puts, and that way if the market does tank, you're like flat. Like if it goes down, like right now, if we had these puts when the market skyrocketed 20% and you had some puts, well, you might have only lost a little bit, like 2 or 5% instead of 30 or 40%. So that's kind of the big difference. But yes, doing these puts do cost you money. And in this case, like $2,000, $2,490 on 600 shares, but you're spending, keep in mind, you're spending $2,000 to protect like a $50,000 position, right? And you could go ahead and get these way further out, like multiple months, and sometimes it's worth it, right? Because now that $50,000 position, your loss, if it went down, you know, you might have spent $2,000 for insurance, but if you didn't, you could have lost $6,000. So this business is about risk management. Hey, you're welcome. You're welcome for the answer. This business is about risk management and just watching the risk at hand, and this is really what it's all about. So anyways, I think we're getting close. We're at 3 hours exactly according to my ticker, 3 hours and 34 seconds actually. So this kind of wraps me up on what I wanted to share with you, at least the basics. We covered some things in detail. Some things are kind of, probably you could find in some of the other videos that I have. I would definitely recommend check out the start options area here that I have. Traders Fly Start Options 101. Getting started. Go look at the freebies. We're going to wrap up that page soon. It's not fully complete, but probably by the time other people are watching this, not live, but sometime within a week or two, that most of that should be done. We've got a ton of products, books, and courses. I've been writing these things for years. It just sometimes helps me clear my brain when you're sitting at the beach. You got to do something with your life. You can't just be on the screen all the time. It's kind of why I'm doing this webinar, right? You don't want to just constantly look at trading and charts all the time. Courses as well helps me out, helps the team out, supports the future videos. So there's a ton of option things if you're into that kind of stuff, and coaching as well. So if you want to do kind of one-on-one sessions, I typically do like one-on-one sessions with people anywhere from just, hey, getting started. Hey, help me get started. Help me learn more about what to do with options, or even detailed coaching sessions. So, prices vary and shift, and we do kind of like a web session one-on-one, and get into it depending on your personal needs, and that's really specific. By the way, is it true, here's a quick question, is it true that 95% of options expire worthless? Yeah, I mean, options expire, so they all expire in the end. They all expire. But yeah, because what happens is people that go ahead and buy them, you get out of them before they expire worthless. So eventually they do expire worthless, because you don't have to hold these options till expiration. You could just hold it for 5 days and get out. So I guess, I mean, I don't know what you mean by worthless, but yeah, most people get out of the options before they expire. So if you're thinking about it that way, then yeah, you could say options expire worthless. I guess that, let's see. Yeah, so anyways, all right. So thank you so much for joining me. For those of you that want to go ahead and get a coupon on anything, I guess we can figure that out. I'll be happy to just say, hey, you were in the room, and mention your name, and we'll go ahead and do that over, let's just say, within the next week. Because if you're watching this as a replay and then you're trying to get a coupon, probably not fair. So for those of you that stuck around, just within the next week, we'll get you a coupon, and that coupon might be good for a month. But make sure you reach out on the website here and use kind of the lower right chat panel, and you can go ahead and send a quick note. Say, hey, I'd love to have a membership on this, or I'd love to get a coaching package, or I'd love to try a course, or, and we can work with you there and get you situated for listening in to the webinar, to the session, commenting, watching, and all that other good stuff. Anyways, thanks again. Hey, thanks for sticking around for the long session. We might do some more of these in the future with some more detailed things with options or other things. So for now, just testing some things out, see how things go with a smaller audience, and then we'll go from there. So enjoy the evening ahead, enjoy the weekend, and make the most of it. And I will see you next time.